have two research papers. The first paper is on government guarantees and financial stability. So that paper is with Mathu Kalimipalli, Vijaya Marisati, and Professor Shankar. Sanjeev Das is going to discuss that paper. And then you have the second paper, which is on portfolio inventory risk of liquidity providers. Pradeep Yadav, Roman Koran, and Vikas Raman. And that paper is going to be discussed by Venkataraman Kumar. So as you can see, we have a fantastic panel and really great research papers. Let me just give a quick introduction to the illustrious panel. So Anant Narayan is going to be our moderator. He's an international banking and financial markets expert. Currently, he's the associate professor of finance at SP Jain Institute of Management and Research. Before joining SP Jain, he has served as senior positions in banking and financial markets. He was the Standard Chartered Bank's regional head of financial markets for ASEAN and South Asian countries. He has a number of accolades, different positions. He's really an expert. We are looking forward to listening to him. Panelists, I'm very fond of introducing Viral Acharya. He was my student, my PhD student, and also he was the founding director of this India initiative in 2012. As you know, he has been the ex-deputy governor, Reserve Bank of India. He is a CV Star Professor of Economics at NYU Stern. So he has started the initiative, as I mentioned, with the NSE. He is a fellow of various organizations. He was served as the International Advisory Board of the Securities and Exchange Board of India. He has been an academic advisor to the Chicago Fed, Cleveland Fed, and Board of Governors. A number of organizations. He's a research associate of the NBER and also CEPR, the Economic Policy Center for Economic Policy Research. So he has many papers, many books, and many awards and honors. Now, Tarun Damodarai, a good friend of mine, a long-term friend. He's a professor of financial economics at Imperial College. He's the chairman of the Inter-Regulatory Committee on Household Finance, constituted by the Reserve Bank of India. Visiting scholar at the Economic Advisory to the Prime Minister of India, Economic Advisor to the European Securities and Markets Authority. Tarun is currently on the Norges Bank Investment Management Allocation Advisory Board and a member of the UK-India Financial Partnership. He is an editor of the RFS. Again, many honors, accolades. Ryan Banerjee is at the Bank of International Settlements, senior economist. Prior joining to BIS, Dr. Banerjee was a senior economist at the Bank of England, where he worked at the Monetary Analysis Directorate, the Quantitative Easing Program, the Financial Stability Directorate of the Liquidity Regulation, and as an economist at the External Monetary Policy Committee Unit. His research interests include business cycles, fiscal policy, financial institutions, macroprudential issues. Again, a bunch of honors and accolades. So now you can see how illustrious and expert a panel we have. I am going to turn it over to Anant Narayan, who is going to moderate the panel. Anant, take it away.
Many thanks for that very kind introduction, Dr. Kose. It's truly a privilege to moderate this very erudite panel, and we will try and squeeze as much as we can from these three gurus. The topic, a roadmap to a vibrant corporate bond market, is admittedly a bit of a roll your eyes, not again topic, in India at least, but do keep the faith. For one, Progress has been achieved in India's debt market over the years, and we need to keep at it. Second, we have a stellar panel today, as Dr. Kose just mentioned, with three exceptional experts, Dr. Ryan Banerjee, Dr. Tarun Ramadurai, and Dr. Viral Acharya, who come in with an informed perspective of both the Indian and the global context. I know I'm going to learn a lot today. So here's the format for today's discussion. First, each of us will provide our take on the topic with opening remarks for about 6 to 8 minutes each. Following this, I will direct some questions at our three wise men. Finally, we will throw the panel open for audience questions. So let me start with my own little perspective of India's credit ecosystem and try and weave that into today's topic. One of the key metrics of any financial services ecosystem is its credit to GDP ratio. At 55% bank credit to GDP, arguably India has a long way to go to create more infrastructure, more jobs, output, and income. India stagnated at about 30% bank credit to GDP between 1985 and 2000. The ratio then doubled between 2000 and 2010 to about 60%. Unfortunately, we ran into much trouble through this rapid rise. First, credit is only the fuel and lubricant. As the engine, the real economy needs to hum alongside. Our real economy seems to have let us down during the later part of the period when lending into infra projects ran into poor execution, poor policies, and our courts. This in turn exposed many issues around governance. Some borrower books had been cooked, there were leakages and frauds, and poor credit appraisal and project finance skills of some banks were exposed. There was also pervasive opacity. Some bank loans had been structured with high upfront fees and low coupons, and then having eaten the cream, banks were left holding very low yielding and unsaleable assets. Unfortunately, we were in denial for some time thereafter. We delayed true asset quality recognition. There was inadequate provisioning. There was a poor recovery from stressed assets. Eventually, banks conducted an asset quality review, somewhat kicking and screaming. While the government introduced a very good insolvency and bankruptcy code, the stock of stressed assets is very large and recovery is still hampered by severe teething issues. Net-net, the credit to GDP ratio faltered from 60% in 2010 down to 55% in 2020. And banks, particularly public sector banks, are in no shape to fund India's large growth aspirations. As banks faltered, we then looked to corporate bonds and non-bank finance companies or shadow banks as an alternate route to give some fillip to the credit to GDP ratio. Corporate bond outstanding has grown from about 8 trillion in June 2010 to over 33 trillion rupees now, well over 15% compounded annual growth rate. 76% of the issuances were by financial institutions, largely non-bank finance companies. RBI and SEBI have also encouraged the growth of corporate bonds, such as with the Basel large exposure framework and other such stipulations. But here is the brutal truth. While we can try and finesse and work around banks, we cannot finesse real economy constraints, nor can we get around the need for governance, transparencies, markets, and common sense. So here are my current set of grievances around our bond markets and the entire ecosystem. First, as ILFS, DHFL, and other cases show, corporate bond markets and some non-bank finance companies have suffered from the same set of governance and real economy issues that dogged bank credit. Besides issues around project execution and ease of doing real investments, our governance infra around risk management and credit appraisals, auditors, boards, rating agencies, and regulatory supervision needs strengthening. There is work happening, but much more needs to be done. Second, issues around asset quality recognition and valuations dog corporate bond markets even now. I can show you corporate bonds where the yield to maturity valuations provided by FIMDA for banks and by SEBI valuation agencies differ by 15 percentage points. Third, participation by India's regulated insurance and pension funds, who should be actively channeling long-term savings into productive investments, is still restricted and low. On the flip side, mutual fund debt assets under management, currently well over 14 trillion rupees, are significantly higher than levels supported by secondary market liquidity. Here, increasing secondary market liquidity is not just a nice to have, it's an imperative. On these fronts, coordination between different regulators, SEBI, RBI, IRDA, PFRDA, etc., sometimes leaves much to be desired. In addition, while nudging issuers and investors into debt capital markets, the RBI itself will not touch even top-rated quasi-government paper, even for repos. To be fair, this needs legislative changes, but the delay has been inordinate. Fourth, on regulations, the circular on credit default swaps is an example. It identifies two sets of participants, market makers and end users. End users are only allowed to buy and not sell protection. I'm not sure how such a market where end users can only buy something and not sell it ever sustain. Finally, we remain beset by taxation anomalies as well. As an investor, if I was to buy a set of corporate bonds directly, I'm subject to a much adverse tax treatment than if I were to buy the same set of bonds via mutual fund. This anomaly does not exist in equity markets, and such issues have come in the way of a growing market liquidity. Now, I know that this is a long rant list, but to sum up, I think our approach to corporate bonds has to be holistic. And admittedly, this is a boil the ocean agenda. Corporate bonds cannot be seen as an excuse to not progress on difficult banking reforms. Much also hinges on the real sector addressing issues around project execution and ease of doing real investments. And of course, around better governance from our risk managers, auditors, rating and valuation agencies, boards, and regulatory supervisors. Beyond these big issues, there are opportunities to ease and widen the participation in various debt and derivative markets. The wish list is long, but some work is underway already, and steady progress, I think, is within our reach. Now, this was a frog in the well version of somebody who's more attuned to Indian markets than the global perspective. I'm now going to head towards our three gurus and get them to opine on the way they see the topic. Why don't I start with Dr. Ryan Banerjee? Dr. Banerjee, if I can turn to you, please, for your perspective on the topic, all yours.
Thank you, Kos, for organizing this event. And it's a pleasure to be on this panel. So given my international perspective at the Bank for International Settlements, I'd like to split my comments into three broad points. The first one is on the supply of bonds, the second on the demand, and then I'll draw a few lessons from a recent BIS CGFS report on capital market development. So on the first point, the supply of bonds, could Indian corporates supply a sufficient volume of bonds to sustain a corporate bond market? So there are high fixed costs to issuing corporate bonds, so only large firms issue them. And perhaps they're already satiated with bank credit. Well, a good place to start to think about this is looking at the current corporate bond issuance, in particular the offshore issuance of Indian non-financial companies. So the idea is here we look at where the nationality of that company is in the BI statistics, then we see how much they're issuing in offshore markets. And using these international debt security statistics, how large could India's corporate bond market be if we just look at the offshore issuance and it was brought onshore? Well, non-financial corporates, Indian non-financial corporates issue, the total amount outstanding in international corporate bond markets issued by Indian non-financial corporates has increased by about threefold over the last 10 years. So in 2010, it was around about 25 billion US dollars amounts outstanding, and by September 2020, it stood around about $75 billion. So there's been a large increase in the amount outstanding. However, if we compare it to a few economies that have successfully established viable and vibrant or relatively vibrant domestic bond markets, that amount's still relatively small. So, for example, Malaysia is one example. The size of its domestic corporate bond market, the amounts outstanding issued by the non-financial corporates, is around about 147 billion, so twice the size of India's current offshore amounts outstanding. Korea has been one of the real stellar examples in the last 10 years or since the Asian financial crisis in terms of growing their domestic corporate bond market. Theirs is around about 550 billion US dollars outstanding. And then the UK and France, similar levels of GDP to India, their corporate bond markets are broadly between 200 to 400 billion. So basically, India's corporate, if we took all that offshore issuance by Indian corporates, it's growing rapidly, but it's still not that large. And so probably to get this sufficient size of supply to have this a liquid corporate bond market and support the whole ecosystem that surrounds it, you want to crowd in some domestic issuance as well on top of those large corporates who are issuing abroad if you brought those back home. But this is possible given that there are high fixed costs to international issuance. If you can have a domestic market, the fixed costs would come down, and it may encourage firms that are not currently accessing international bond markets to issue in India. So let me turn to my second point on demand for corporate bonds. And one of the striking facts when you look across countries is just how correlated the size of the corporate capital market is with the size of the institutional investor base. And who do we mean by institutional investors? We mean insurance companies, pension funds, and collective investment vehicles such as mutual funds. And India has a relatively small institutional investor base by international standards at around 25% of GDP when we looked at this a few years ago. Compare that to Brazil, which has an institutional investor base of around about 75% of GDP, Korea and Chile approaching 100% of GDP, and South Africa at about 150% of GDP. And just to put this on par with the economies with some of the most vibrant capital markets, the United States, the UK, and even Switzerland, they stand around about 200 to 250% of GDP. So there's still a long way in terms of growing that demand base. I mean, and following Chile, a lot of emphasis has been placed on the role of pension funds, who naturally have demand for long maturity assets like corporate bonds. And indeed, recent studies have shown that corporate bond issuance increases strongly in the years following reforms to raise savings in pension funds. But it's not just the size of the base that's important. You also need, as Anarth said, diversity investors. Diversity and diverse investors bring liquidity. They have different horizons, different balance sheets. And currently, India's institutional investor base is dominated by insurance companies. So in economies with deeper corporate bond markets, there's often a more balanced split between the three types I mentioned. And so developing the mutual fund sector, developing pension fund savings would help not only develop the corporate bond market, but also help financialize savings and putting them to productive use. But the key point to remember is that developing the institutional investor base takes time, decades even. It just takes little bits of saving every year to accumulate to these amounts. And this requires a stable environment and commitment to long-term goals. And such concerted efforts, if you want to look for examples, occurred in Chile and Australia, who have successfully built over the years their institutional investment base. And in addition to growing the investor base, a prudent expansion of invested options, so you broaden the role of institutional investors is important. Conservative risk limits on pension funds and insurance companies can limit their investments in corporate bonds in favor of government securities. So finally, just to wrap up, I'm going to draw a couple of lessons from a recent BAS CGFS report on capital market development that Viral was part of, or chaired actually. So the pinch point in India doesn't seem to be financial market infrastructure. A lot of effort has gone into this in recent years. And when you look at the government bond market, you just see how tight the bid-ask spreads are. On an international comparison, they're as close as they are to some of the most liquid advanced economy capital markets. Rather, it's other findings from the report that seem more relevant for India. Firstly, corporate capital markets are larger in economies that are more efficient in settling legal disputes. And this also helps the banking sector as well. Also, economies that have predictable insolvency regimes have larger corporate bond markets. It's a key factor we found was the recovery rate and the time to insolvency, which are really the time it takes to resolve insolvencies, are also important. And when we had discussions with international investors, they highlighted their comfort in investing in local capital markets in emerging economies, but not in corporate bond markets. And this was largely due to concerns about the legal processes. And the final point I'd like to say is information is the lifeblood of capital markets. And at the heart of it is robust disclosure. And from the report, we conducted a survey of market participants across 10 economies. And one of the strongest findings from the survey was that investor concerns about the quality of disclosure significantly affected their ability to effectively price risk premia appropriately for the risk profile of the firm. So when you have weak disclosure, it prevents investors from separating good from bad risks and ultimately raises the risk premiums for safe and high quality issuers and reducing their incentive to invest at the issue. So overall, enhancing these factors, I think, would be important in helping to lower risk premiums and encourage domestic issuance. And with these points, I'll stop here and hand back to the chair.
Thank you so much, Dr. Banerjee. That is an awesome amount of insights which you've packed into a few minutes on the supply side, on the demand side, and the findings from the BIS CGFS report. Lots of questions that are going to come your way subsequently. But in the meantime, if I can turn to Dr. Tarun Ramadurai for your comments, Dr. Ramadurai.
Thank you very much for inviting me to be a part of this panel. I've enjoyed Anand's introduction and Dr. Banerjee's remarks as well. Just to add to a few of the statistics so we sort of understand what the state of play is at this point. India's overall total corporate debt, the corporate bond market, which I might call arm's length sort of secondary market debt, is about 8% of the total, which is fairly small. And if we were to compare that to other countries, for example, the average emerging market equivalent share ex-China is about 30%. And for the average developed markets, about 25% or thereabouts. This amounts to about 16% of GDP in total, the total aggregate issuance, and it's been stagnating for the last couple of years. So, this is a problem that has bedeviled the country for a long period of time, and these are just some statistics to tell you that there hasn't been a whole lot of movement, and it does not account for a very large share. Now, on its own, you might not worry too much about this, but let me try and sort of outline a few reasons why I think it is important to continue to think about this issue, despite the fact that innumerable opinions have been expressed about this. So the first one is, obviously, it provides an alternative source of funding for companies, and I thought that Dr. Banerjee's thoughts about the fact that there's been this offshore express demand is an important one, suggesting that this source of funding is an important one. From a more sort of banal corporate finance point of view, from the individual firm's perspective, having access to corporate debt potentially enables firms to optimize capital structure in an environment in which they have frictions. These are from the textbook models. Of course, there are some issues of the tax treatment that were raised by Anand as well. I think perhaps the most important issue is the issue of transparency that Dr. Banerjee briefly touched upon. I'm going to spend most of my time talking about those issues. And I will tell you why I think that this transparency is something that many participants in the current system aren't necessarily interested in. And I think that one of the deepest problems that we've had in the development of capital markets, in the corporate bond market in particular in India, is that there are so many parties that stand to lose from the deepening of the corporate bond market. And this is not to point the finger at anyone, but just to say that there is a gridlock here of interests which are genuinely aligned against making this happen. From an investor's perspective as well, it provides the opportunity for additional diversification. I will talk a little bit more about the institutional investor point and about the Indian structure a bit more as well. So let me try and turn to this sort of first point, which is about the poor incentives point. So let's think about what it would mean if there was a very efficiently functioning and liquid corporate bond market from three different groups of people. So three different constituencies. The first is banks, the second is corporations, and the third is the government. And I will try and give you some reasons why I believe that it is in nobody's interest at the moment, none of these three sets of participants, to make this happen. The first is banks. So banks, of course, as we know, are sitting on lots of bad loans that have been issued over a period of time. This has been an ongoing problem in the Indian system. And of course, they're not expected to, in any sort of very transparent way, mark these loans to market. But if, on the other hand, there were a liquidly traded corporate bond for each and every loan that was equivalently made to a corporation, then automatically what happens is that we have price revelation, and we know exactly what the state of the corporate debt problem is at any instant in time, because this is now marked to market. Now, obviously, banks don't have great incentives to have this sort of revelation of the extent of a bad debts problem coming to light. And there are few, therefore, incentives for them to trade in such a corporate debt market. In fact, if anything, there's a reverse incentive to ensure that the price of their poor loans reflects as little information about the true poor state of affairs that there is out there at the moment. So that is kind of the first problem, which is that banks don't have a great incentive to participate in this market, and they are the single largest maker of loans and provider of credit to the corporate sector in the country at the moment. From corporations' perspective, it is much the same story, which is with large corporations with significant levels of unsustainable debt, the increasing levels of publicly visible, not hidden in the back of the balance sheet debt is fairly unattractive to them, certainly for some subset of the corporations out there. Now, of course, there's a crowding out problem because the fact that the bad corporations don't want to persist means that you're not going to get liquidity because you need a sufficient amount of diversity in there. But you're not going to get that. So in some sense, there's incentives also for them to lobby and to support the perpetuation of information asymmetries that will inhibit liquidity in the market for their debt, because obviously price revelation is not really good when you have large piles of unsustainable debt that you're sitting on. Now, lastly, from the government's perspective, there's been a lot of interest expressed in having a corporate bond market. But in the short run, if you did have this corporate bond market generating sort of information about the true scale of the losses, in some sense, this is not really great news for the bank. So this is sort of for the government. So this is the classic problem that there is a short-term cost and a very long-term benefit for the development of a corporate bond market. And so there is less incentive in the short run for them to go out there and actually make actions to develop a corporate bond market, despite the fact that their intentions may be stated to being that we'd like to have a corporate bond market developed. Now, the second thing I want to talk about a little bit is the fact that there is a demand side issue as well, which is what is the investor base for corporate bonds? Now, in most countries around the world, insurance companies are usually the largest institutional holders of corporate bonds. And the reason that that is the case is because they provide some risk premium, but also a set of predictable cash flows. And so that matches pretty well with their anticipated liabilities, especially for life insurance corporations that have a set of liabilities that they have to essentially pay out from time to time. But they do get a risk premium, so they get some enhancement on holding corporate debt because it's better than holding a government treasury security. Now, the problem is that in India, the insurance sector is dominated by one monolithic corporation, which is the Life Insurance Company of India. So even though, as Dr. Banerjee correctly pointed out, you might want diversity of the investor base to provide liquidity, even within the natural investor base, there is not much diversity to be had because the Life Insurance Corporation of India is sort of the only game in town in this case. Now, as innumerable committees, including my own, have talked about, the growth in the insurance industry and entry into the insurance industry has partly been hampered by distribution practices that have not always benefited the final holders of policies. Trust is very low in insurance, redress is generally an issue. And if there were moves to level the playing field by regulating premiums, by changing policies on the lapsation and so on and so forth, that would cause more competition to come into the sector, but potentially at the cost of reducing LIC's market share and its revenue. The problem with that is LIC is an enormous contributor to the government budget because it is one of India's few state-owned profitable businesses. And so here you have another incentive problem, which makes it difficult for us to. So in some sense, the development of the corporate bond market goes hand in hand with the development of the insurance market. And so these problems are deeply linked and need to be thought about together. So having made these points, I'll stop here. And I look forward to Daryl's remarks.
Thanks a lot, Dr. Ramadurai. It was interesting when we were having our exchange on mail before the panel discussion. All these issues that you related in relation to whether the ecosystem actually wants a vibrant corporate bond market, you'd written about this several years ago. And unfortunately, the issues seem to remain as they are, at least from your perspective. And I guess your broad question is, can we handle the truth, to use a very Hollywood kind of a phrase out here. But thank you for those comments. Let me now go last, but definitely not the least, Dr. Acharya, all yours. You know this ecosystem better than anybody else, so go ahead, all yours.
Great. Thank you, Anant, and thank you, Kos. It was great to hear Ryan's and Tarun's remarks. In some ways, what I'm going to say is going to build upon what they said. In the report that we had jointly done, Ryan and I were involved with for the BIS when I was at the Reserve Bank of India. One of the first points we had made was that what the development of a corporate bond market requires is actually first and foremost sound macroeconomic fundamentals. That's almost a key requirement for the corporate bond market to develop. And what I mean by this is not in a one-off year. We meant that this has to be something that sustains itself over a period of time. And as Tarun was highlighting, we have these deep issues about who the institutional players in India are likely to be in this market. And many times they are government owned. And then there are deep conflicts of interest as to whether they should be buying government bonds or whether they should be buying the corporate bonds. I'm going to get to this point. In my view, no matter what we do on disclosures, no matter what we do on insolvency and bankruptcy code, no matter what we do on the financial plumbing, etc., for corporate bond markets, in the end, as long as India's fiscal deficits and debt to GDP ratios remain where they are, my assertion is that India cannot have a thriving corporate bond market. Right now, we have fiscal deficits. Let's look at pre-COVID numbers. On a consolidated objective basis, they were on the order of 8 to 10% of GDP. The debt to GDP ratio was probably anything between 60 to 70% of GDP. And if you start including off-balance sheet debt of the government, it would be higher. These numbers are likely to go to 10 to 15% of fiscal deficit and 80 to 90% of debt to GDP ratios. If you take the fiscal deficit number, that is larger, even pre-COVID, that is larger than the net savings rate of the economy. So when you look at the net savings rate of households, that will be on the order of 6.5 to 7% of GDP. So the government of India dissaves more than what the households are saving. The corporate sector in India is also actually a net dissaver. And what this simple aggregate observation means is that on the margin, India is financed by foreign flows. And therefore, this is not to say that every single corporate issue is financed by foreign flows, but it says that in an aggregate sense, on the margin, financing that India raises has to be met by the outside world because the savings in the domestic economy are not as large as the dissaving that the government and the corporate sector undertake together. Now, what you observe from this, and I'm going to make two important points in this regard, is that I think there are only two conditions under which the corporate bond markets in India thrive. Right now, there is a coincidence of both these conditions in India. Okay, so let me first explain the two conditions individually and then come to the example that right now there is a good coincidence of both these conditions. The first condition is that foreign flows into India have to be very high. So in my book, which was released a few months back, Quest for Restoring Financial Stability in India, there's a speech called The Crowding Out Effects of Government Debt. It was my last speech as a deputy governor. It was released just a day before I finished my term. It wasn't endorsed by the Reserve Bank of India, but because I had given it as a deputy governor, I thought it was in public interest to put it out before I left the Reserve Bank of India. What we found in the analysis shown in that speech is that government issuance of debt doesn't crowd out the issuance of corporate bonds in India in times of high FPI flows. So how much corporates issue in the Indian bond markets doesn't have any relationship with Government of India debt issuances as long as foreign flows are high. However, if you look at years when foreign flows are not high, so they are below median flows or they are actually foreigners are pulling out their funds from India, the corporate bond issuance comes down dramatically. And this is to be expected if you believe in this crowding out explanation for lack of a corporate bond market in India, because government bonds have so many convenience yield properties attached to them. They are more liquid. They are issued on a weekly basis, at least the benchmark bonds. It's collateral that you can tender at the central bank for liquidity purposes. None of these privileges, for the right reasons, in some cases, exist for corporate bonds. So when foreigners pull out, the government bonds become the dominant asset held by the Indian savers. And that is compounded by the fact that you have public sector banks, you have Life Insurance Corporation of India, you have pension funds being run by the government, because in India, all of these work with the government and sometimes the central bank to form what Dr. Reddy in his foreword to my book calls as a Hindu undivided family. They all work together to keep supporting government's finances without ever keeping proper accounts of what is actually happening in the process. So that's point one, which is that the only way, one condition under which corporate bond markets can develop in India is if foreign flows remain very benign. Then the corporates go and load up on corporate debt, either in the foreign markets or because of easy liquidity in the domestic markets, if the reserves are being purchased by the central bank and being converted into rupee liquidity in India. Now, what is the problem with this form of corporate bond market development? That it will be very subject to the tantrums of the foreign capital flows. If your corporate bond market can function well only when foreign flows are high, then when foreign flows leave India, it's going to have a hard landing and possibly, certainly a drying up of the corporate bond issuances. Let me now come to the second condition. There is a second condition under which the corporate bond market access can get relaxed, which is that the central bank balance sheet buys up a huge quantity of the government bonds which are being issued. Okay, which is that it's not the aggregate liquidity constraint is not being relaxed by the foreigners, but it is actually partly getting relaxed by the balance sheet of the central bank. And of course, if the central bank buys up the government bonds and never essentially releases them in the market again, so it kind of just becomes a warehouse for the stock of government bonds, the temporary liquidity that is created will again start chasing the corporate bond markets in the short run. Now, what is the problem with this form of development of the corporate bond market is that typically, when central banks grow their balance sheets to very large sizes, certainly in emerging markets such as India, where growth impulses are there, unlike the developed world, where growth itself has sometimes been difficult to come by. Countries such as India also have significant supply side constraints, so inflation is always lurking in the background and waiting to take off. In these times, when the central bank engages in massive government deficit monetization, money supply growth becomes very high. This is something that Anant Narayan has been writing quite a bit about over the last year. And when this happens, the central bank essentially starts adding to the inflation impulses. And gradually, from wherever inflation starts, whether it is cost push, whether it is coming from food, whether it is coming from fuel, all of these start getting generalized because the monetary conditions are actually facilitating the buildup of inflation expectations. So what I'm trying to say is that given India's macro constraint, that the government is dissaving a lot relative to the savings of the Indian households, the two conditions under which corporate bond market can develop in India from a macro perspective is if foreign flows are its primary driver, or if the central bank balance sheet is its primary driver. Indirectly, central bank is not buying corporate bonds directly, but it's indirectly through monetization of government bonds. But both of these are associated with the misfortune that one exposes you to external sector fragility and the second exposes you to inflation vulnerability. Right now in India, both of these conditions are very benign. The central bank has been monetizing government deficits indirectly through secondary market operations, and the foreign flows are very benign. As a result of all this, the liquidity conditions or the financing conditions, financial conditions index in India is actually surprisingly one of the most benign it has ever been in recent history. So corporates are actually able to issue paper at the very short end, sometimes even at rates which are lower than the central bank's reverse repo rate. In my view, this is not the way to develop the corporate bond market because this is associated with vulnerabilities and fragilities. And I'll just make one last point here that I think we should be quite worried about short-term debt issuances by corporates in particular. In my speech that I was referring to, which is in the book, what we found was that when the government supply of paper becomes high, and neither the foreign flows nor the central bank are absorbing it, corporates have a tendency to move to shorter and shorter maturities. Right now, perhaps the shorter maturities are being chosen because the long end of the yield curve isn't moving much. It's fairly steady around 5.75 to 6.25% in that band. But the short end has come down very dramatically because of this gush of liquidity in the system, which is not being absorbed. And so it makes sense for the corporates to take it on. What's the vulnerability associated with this? In case inflation causes the interest rates to rise, and that is the only way forward. I don't see how interest rates can come down unless we basically completely decide to sidestep inflation altogether, which could arise if basically monetary policy gets fiscally dominated. But it's going to create a rollover risk for these corporates because they are issuing very short term, and the moment interest rates spike up, they will have a problem. This is how the non-bank financial firms crisis happened in India. They had borrowed very short term after the post-demonetization glut of liquidity. When oil prices rose during April to October 2018, interest rates had to be raised in order to curb inflation. And lo and behold, they had to pay higher interest rates, and everything came to a screeching halt. So let me wrap up. I think what I'm trying to say is that unless we fix our macro conditions on the government debt and fiscal, unless we stop financial repression, which is that our financial sector firms are always under pressure to buy up government bonds, and unless we therefore move to a situation in which the government debt market and the corporate debt market are roughly on a level playing field in terms of the space that the private corporate bond market has in India's financial system, I'm deeply skeptical that we can have a corporate bond market which is sustainable. We will get these ups and downs, like the episode we are in right now, where corporates are able to issue easy debt. But I think this is not very sustainable in my view. It's subject to a lot of vulnerability, both to interest rate risk as well as to the risk of foreign money outflows. Let me stop there. Thank you.
Thanks, Dr. Acharya, and ties in perfectly with the arguments you've made in your book as well, in the opening chapter. So about fiscal dominance, etc. So I'm going to start with the look. What we'll do now is I think we have about 10-15 minutes for questions until Dr. Kose or Tirthankar raise their hand and ask us to shut up. We'll go on with the question and answer session now. So what we'll do now is, look, I don't know if you've had the misfortune of seeing Indian news TV shows where we have very robust discussions bordering on the obscene. We won't go to that level, but I would strongly recommend that you please raise your hand in case you want to make a point, even if the question isn't directed towards you. Viral, I'm going to pick on you first. You made this point that corporate bonds can only do well if either we have a steady flow of foreign inflows coming through, or if the RBI is effectively monetizing the fiscal dominance, which otherwise is underway, right? The inevitable question, which seems to be there on people's minds right now, is economics being rewritten, at least in the developed markets, where nobody uses the term MMT, but everybody talks about fiscal spending, which is financed by central banks, which to me is MMT. Therefore, are we entering a realm where this flood of liquidity, which Indian markets are definitely seeing right now, especially equity markets, continues for longer than we expect, and therefore rewrites a lot of the things we're used to? All yours, Viral.
Thanks, Anand. Yes, see, I think it's a mistake in my view to compare India to the developed economies for both the reasons that I mentioned. We are not a safe haven currency, either in terms of the quality of our institutions as a country, or in terms of just the historical patterns of sudden stops.
Sorry to interrupt, Viral. I'm not suggesting India's can follow MMT. I'm saying, will global liquidity in the developed markets, the hard currency issuers, will that remain robust for a long time, given Fed speak, etc.?
Yes. See, in the short run, perhaps the risks are low. And this was true even after the global financial crisis in 2009, when the Federal Reserve embarked on quantitative easing. Probably the half-life of the next sudden stop wasn't less than a couple of years. But we know what happened in 2013, which is that in May, third week of May, when Federal Reserve Chairman Ben Bernanke suggested that we might start tapering off our quantitative easing program, we got caught in a tizzy with 4 other emerging markets. And why did we get caught during that time? Because our macroeconomics were not great. Our fiscal deficits were high. Inflation was close to double-digit levels. There were brewing problems in our financial sector. I'm not convinced that fundamentally our macroeconomics has changed too much since then. We did improve, but we seem to have marched steadily towards reaching the same situation of high fiscal deficits, high inflation, and not having resolved the NPA problems of our banking sector. So I'm not saying that the vulnerability to the corporate bond flows is in the next 2 to 3 months. Of course, a shock can arise unexpectedly from anywhere. I'm saying in an expected sense, this is likely a medium-term risk, and the only way out is to fix our macroeconomic fundamentals.
Got it. Since nobody's raising their hand, I think they're all in violent agreement with you. Dr. Banerjee, I'm going to come to you next. You gave a lot of good statistics about comparisons with other countries, Brazil, Chile, and so on and so forth. Brazil was kind of interesting because they have the same kind of problems that India has in a sense, high fiscal deficit, high debt to GDP, and so on and so forth. Yet when you mentioned 75% as the ratio for Brazil, that came as a quite pretty high number. Given your vantage point of having seen what other countries are doing, are there any quick takeaways for India in terms of what we should do here and now to improve maybe the availability of credit to our local corporates?
So I think there are no quick fixes here. I think that's the key thing, and I think it's going to be one of these things that just takes like a long plan and time. So looking at the examples of Korea and France, they spent some time in their development of their corporate bond markets over the past 20 years, developing the investor base. But thinking about, okay, so India has a growing economy, it has a lot of external financing needs. How can we help them diversify those external financing needs? How can we help develop long-term savings that help match that, so where the liabilities of the corporates are exactly the thing you want to match against for the saving person, and that's where long-term life insurance type policies are very useful. India has it's fortunate in the sense that its growth rate has been, or its potential growth rate is relatively high to finance these, and so setting up the taxation, and taxation is a very important part of this. So setting up the taxation part and keeping that as a stable thing going forward for several years is very important. I'd actually just like to come back to the question that Viral you asked Viral a moment ago about the international investors as well, because one thing that is important if you're going to have a lot of international, which helps stabilize international flows, is not only that you have external assets that can be brought back in at times. So not only is this domestic savings or these insurance, the taxation should be helping savings to be channeled to Indian corporates. It's also helpful if some of that is also going to accumulate foreign assets abroad. Exactly at the time when financial conditions tighten abroad, is what you often see is then domestic pension funds in Chile or in Peru and Latin America, they bring their money back into the country because they see, look, the premiums are widened. This helps me actually meet my return goals, and I'm going to repatriate my assets. And so, it's a sort of, in order to sort of stabilize those international flows, accumulating foreign assets is also important. But when India is running such large current account deficits, doing this systematically becomes very difficult.
Yeah, it's kind of interesting because right now we have a current account surplus, even if temporary, and therefore there are surpluses that we can probably use to acquire assets like you mentioned when the going is good. One more question to you, Dr. Banerjee, and I'm going to flip that to Dr. Ramadura as well. In connection with the international comparisons, one of the things that India has been talking about is inclusion into global indices for debt funds. So the JP Morgan index, the Bloomberg index, and so on and so forth. Do you think that's a step in the right direction in terms of getting more interest from global investors, especially the long-term real money investors, into the Indian ecosystem?
So it's a two-part question, I think, in my answer. The first one is foreign investors, can bring in global state-of-the-art practices. They will push for higher disclosure of the firms that they are going to be investing in, and often that's also part of what the indices are doing too. They want to ensure that the firms in their indices meet some certain international standards. And in the report that Viral and I worked on for the BAS, this is one of the points that we thought was important. in that foreign investors, they bring know-how and good practices with them. They also help lower risk premiums. So as Vera was saying, that the foreign investors come in, they push down the, when the flows are coming in, they push down the cost of borrowing for domestic issuers, and it encourages domestic issuance. So that too is important. But then they come with this volatility part. And I think one of the key sticking points for the Indian inclusion in these international indices are the capital controls, or the restrictions on bringing money in and out of India. And so, so there's a bit of a question of, until you think you're going to have macro stability, and the institutions to manage that macro stability from this capital flowing in and out when global monetary conditions change. There's a question about the timing of how you can balance those risks.
Right. Thanks, Dr. Banerjee. Dr. Ramadurai, I'm going to flip it over to you. Same set of questions. I'm going to add a new question to you as well. You spoke about, for instance, the Life Insurance Corporation of India being a large insurance player and with restricted amount of holdings. Now, one of the things which happens in the insurance sector is you have IRDA, which kind of restricts what insurance companies can do with their corpuses. Similarly with PFRDA for the pension funds, etc. Would you recommend that these entities should be freed up to invest a lot more openly based on their own board or risk management appetite, rather than have regulators tell them that you can't invest more than X percentage of your corpus into corporate bonds and so on and so forth?
Maybe I'll take that first, and then I'll get back to some of the macro questions that were asked and answered earlier. So as far as that concerned, there's basically two broad issues, as far as I can see. The first is we've always had this kind of alphabet soup of different regulators regulating slightly different patches of what's going on. And as a result, the set of regulations can become so thick because there is some coordination amongst the regulators, but in some of these areas where functionally a pension fund might be sort of thinking about investing in a certain set of assets and it has certain restrictions placed on it, but an insurance company that is selling a product that looks not dissimilar from some of the things that a pension company might be trying to sort of get to you in terms of pension savings means that they come under an entirely different ambit. So what then happens is it becomes extremely confusing about what you are and what you are not permitted to do, which generates an enormous amount of conservatism. That having been said, some of that conservatism is warranted because, I think there have been these important long-term reforms to sort of try and make sure that the governance of public sector financial institutions is on a very firm footing. Because what you don't want to be doing is to say, look, off you go, you can go and invest in whatever you want in a completely unconstrained fashion, but then have fairly poor corporate governance standards or, in some sense, not adequate risk management going into those organizations, which then results in a sort of a disaster that builds up at some point in the future. So, in some sense, you want to sort of resolve the governance problem first, and then, yes, you want to provide people with the autonomy that to then go out there and invest and not have tight restrictions. I think one of the things that we're very fond of in India is to make a law to regulate specific instances of conduct. And I feel like one of the things that we should be trying to do less is, maybe police the conduct, but then not do that through putting in very tight restrictions on what people can and cannot do. On the foreign question, I think this is important because I think one of the things that hasn't come up in the discussion thus far is that while there are certainly pull factors into the Indian environment, which is to say that capital flows are being pulled in by the fact that maybe there's an expectation that future fundamentals are going to do well, and some of my own research in the past suggests that that may be the case. There's also a very strong push factor, which is to say it is also the case that capital flows are going to be pushed out of their home environments towards places where there may be a higher relative yield. And so one has to be very careful about the fact that what is happening right now is there is almost complete unanimity amongst the emerging market fund managers that now is a terrific time to be going out there and investing in emerging market paper. And there is also an enormous amount of allocation to these funds. For example, JP Morgan just closed its emerging market fund because it can't take any further amounts of capital because it's at its limit, it's at capacity. This has not happened very frequently in the past, several years. So I think one has to be very careful because as Viral says, if you accept a huge amount of capital, plus you're kind of fooled into believing that the fundamentals are good for making long-term projections as an Indian corporate thinking about making a multi-year investment that's financed by bonds, then if the cash flow projections are overtly optimistic and they're financed by short-term, fairly volatile capital flows, then you're really setting yourself up for a serious problem at some point in the future, and maybe not in the not too distant future as well. So I agree that now is a time to be cautious, and now is also a time to be doing long-term structural kinds of plays rather than thinking about maybe just taking the money and trying to grow the market quickly.
No, great points, Dr. Ramadurai. In both the answers that you gave, this is the classical pendulum problem, right? How far do you go, let the pendulum swing? Do you be very conservative and then you sort of have a self-fulfilling prophecy of not getting growth, or do you go too far to the liberal side and end up in the super? I guess we're looking for a golden mean somewhere. Now, I'm very conscious that we're running out of time. Dr. Kose has been very polite and not thrown a tantrum as yet. But Dr. Kose, over to you in case you want to throw some questions up to the three panelists that we have here.
Listening to Viral and some of the other panelists, it's a pessimist perhaps, or Viral or any of the other, and Ryan, is there learn from the other emerging markets or even developed markets? Because they must have had growing pains as well. What do you think regarding the development of corporate bond market? Viral, what do you think?
No, I didn't mean to be pessimistic. I just meant to be very matter of fact about what the macroeconomic realities are. I think my sense is we can't compare ourselves right now to South Korea as far as our macroeconomy is concerned. I think we would still fall in the realm of emerging markets in the strictest sense of being an emerging market. Because fiscal deficits are high, debt to GDP ratio is high, inflation is high, the growth was slowing down pre-COVID. These are significant considerations to keep in mind. So as far as the lessons go, right now, my lesson that I would recommend from the experience of other emerging markets is that if you go along with the global liquidity glut and simply load up debt on the corporate balance sheets, without fixing the macroeconomic vulnerabilities, this could come back to haunt us. So I think my lesson would be one of caution. That sucking in all the money that's coming into the corporate balance sheets may not be wise if we are not going to fix the macroeconomic realities in parallel along the way.
Thank you. Any of the other panelists? Ryan, you want to pipe in?
I was just going to say that thinking about the origin of the Korean success story of developing its domestic bond market was exactly to avoid excessive exposure to international capital, short-term international capital flows. And so bearing that in mind, that I think one of the lessons from Korea and Malaysia for that matter is what do you want to make sure is that the incentives are for firms to issue longer term debt so that there can be risk transfer from the corporates to the lenders. And so these things may need to be kept in mind as these markets are being developed.
So, one of the points that Viral made about low interest rates, and, he's right, CP rates are going at 3% and below 3%, which makes no sense when your reverse repo rate is 2.35%. But the actual quantum of credit growth in the country right now is extremely low. And it's not just bank credit. Bank credit is about 5.7% year-on-year growth. Even the overall ecosystem, along with corporate bonds, CDs, CPs all put together, is a fairly low number right now. But I guess the point that Viral makes about the need to improve macros is spot on. I don't think anybody can disagree with that. And a lot of future investments done by corporates also depends upon India's ability to actually run through with investments and get the execution right. The last credit cycle that went bust was because all the project finance which we kind of sponsored didn't see the light of the day and ended up as non-performing assets on the books of the balance sheet. Now, is India doing enough real sector reform to ensure that productivity and investments can go through? I think the jury is still well out on that, and one doesn't know on that. But sorry, back to you, Doctor.
Sorry, Ghosh, let me just sort of respond to your statement. I can see that the tone is seemingly pessimistic, but I think one can think about it in a slightly different way, which is the tone has been optimistic for a long period of time. But what is frustrating is that there is a lack of action on some of these issues that has been have been proposed several times. I mean, maybe that's what, certainly from my perspective, one of the things that I feel is that it's not as though these points have not been made before. It's just that what would be nice to see is concerted action on these points rather than, say a fairly quick fix solution to some of these problems, which is, it's not going to happen overnight. It's not happened for 20 years. Maybe there's a reason that that's the case. Maybe we should start looking more structurally at the problems that there are and try and get around to fixing this eventually. But if we do, there's a huge amount of optimism about what could happen if we had the right institutional setting.
Thank you. Let me just thank you. This has been a really wonderful panel. I learned a lot, but I did see a few questions, raise hands and so on. So Anant, you can. So let me just thank the panel. This has been one of the most insightful panels I've been part of. So this is great. I expected it as much, given the panelists and their expertise. So thank you guys. Thank you so much. Anand, you there are a couple, I did see a few questions, raise hands and so on. I think we have like 2 or 3 more minutes.
Okay, so in this case, Dr. Kose, I'm going to take one question which I found very interesting. This is from Ashish Kela. Viral, I can't let you go without this. There was a news item today, unconfirmed, that the inflation band for the MPC might be modified from the 2 to 6% range. It's an unconfirmed Bloomberg report. It could be a trial balloon being floated. Any thoughts on that front, moving the 2 to 6% band?
Yeah, I don't know how serious they are about it. I thought that the Urjit Patel committee report had done all the groundwork to help understand why 4% was a reasonable target. I think I'll give actually somewhat of a non-economist answer to this. I think those who think that it's okay for India to run 6% inflation, I wish they would one day go into the poor man's shoes and spend their life that way. I think the reason why CPI should be at 4%, the reason why India's basket of CPI is the right one, in my view, is because food actually does constitute a very large part of a poor man's daily consumption. And when food and fuel are actually at very, very high levels of inflation, not just the broad-based inflation, which is also high in India at present, actually these people seriously have to constrain their consumption basket. So my sense is, unfortunately, the story of growth and inflation trade-off in India has become one of the rich and the urban economy. It's actually not paying enough attention to ensuring that the basic levels of subsistence and consumption remain at decent levels for the poor. And I think we really ought to think hard about these trade-offs. We are not just designing an economy for the 300 million Indian people who can live comfortably no matter where the inflation is, because they are way above their subsistence levels of consumption. I think India has got to find a way to deliver growth without allowing inflation to run away to such high levels. And I think that means what Tarun is saying, which is I think India has to invest in growth structurally, not through just pump priming of the economy through easy credit and easy liquidity conditions, because that is what is associated with inflation. And I think that can't be a sustainable mode of growth for the poor people in the country. That's at least my limited take on this issue.
Thank you, Viral. Dr. Kose, I'm going to take one more question just on the spirit of this particular panel discussion.
Please.
This is for Tarun and Ryan, both of you. Which developing country has a corporate bond market that India should aspire to emulate? This is from Ravi Chandran. Either of you and both of you, if you can please take this. Tarun, you want to go first?
Sure, I'll give you a non-answer, which is generally common in these kinds of situations, which is, I think we should try to, kind of cut our coat to fit our cloth and think about what kind of sovereign bond market is appropriate for the Indian context, given the financing needs of Indian corporations. And I think rather than sort of aspiring to a type of corporate bond market that might be something that's external and suited to the conditions that might exist in some of these other economies. I think we should try and develop something that benefits the objectives that we want to hit, which is high economic growth with transparency in our economy.
Thanks, Arun. Appreciate it. Ryan, you want to go next?
There are lessons to learn from others' development, but I don't think there is, exactly as Tarun says, there is any, if we a cookie cutter recipe here. India has specific institutional background. It comes from a certain point. It's very different from Korea and Malaysia, the sort of poster childs. It's also different from Chile, which has developed the institutional investor base. So there are lessons to learn, but there is a question of thinking very hard and thinking what's going to work in India.
Fantastic. Dr. Kose, I think we've already imposed on our panelists a lot. Dr. Banerjee, Dr. Ramadurai, and Dr. Acharya, this was a complete privilege. Dr. Kose and the NSE team, thank you so much for this privilege. Truly appreciate. I thought this is a very rich discussion. I wish we could go on for more. I have tons of more questions to throw at the three of you. But at the interest of time, I've handed back to Dr. Kose. Thanks again.
Thank you again. Let me just thank you. This has been wonderful, and I appreciate all of you in participating in this. We're going to assemble back in 3 minutes for the presentation of the research papers. Thank you, guys. Thank you very much. So let me just say, we have a great paper coming up. This is one of the supported papers. Do government guarantees help financial stability? Evidence from an emerging market. So the authors are Madhu Kalimipalli, Vijay Marisetti, and Shankar. Madhu, take the floor, please.
Thank you so much, Professor Kose, and the NSE team. Tirthankar was a good friend for making this possible. And today's panel actually provides a wonderful segue to this particular topic. I think the whole issue is really about the relationship between the government guarantees and financial stability. And that has been a subject of intense debate post-GFC, the global financial crisis. And in particular, post-GFC, the government interventions have taken the form of guarantees, implicit, explicit, recapitalizations, and loans around the world. However, the literature has found a conflicting evidence on how the government guarantees and subsequent bank risk taking could happen. So there is a lot of literature that is cited out there which points to that possible conflicting evidence, right? Now, in particular, the government guarantees can increase firm value. That can happen through a reduction of asymmetric information, or improving credit ratings for firms or banks there, lowering potential systemic risks, providing a downside insurance, or improving liquidity provision. Right? On the other hand, the government guarantees could have adverse consequences too. So that would be sort of excessive leverage, tendency to take excessive leverage for banks. You heard that in the panel today. Moral hazard problems by the borrowers, unproductive use of capital, and possible counterparty risks to the guarantor arising from system-wide shocks and potential bailout costs for the taxpayer. So, so as a result, the ultimate effect of government guarantees is really an open empirical question. Our extent work has looked into this from various angles, who benefit from capital infusions, the sovereign risk impact on supported banks, as the supported banks or the guaranteed banks inherit the implicit sovereign risks, the guarantee impact on banks' put options, and Acharya's work also has looked into how guarantees impact the too big to fail bond spreads, on bank bond spreads. In this paper, we shed light on this debate, in particular by focusing on how government guarantees can help promote financial stability. So specifically, we asked, do government guarantees help lower the systemic risk and help financial stability, right? And provide evidence through the lens of an emerging market. This graph here shows a sort of visual of how capital infusions have evolved in India in the last 10 years. So these are all converted into US dollars at a $72 rupee per dollar rate. And we've seen that currently it's around $12, $13 billion in 1718. And then according to the current estimate, 2019-20, it was around $6 or $7 billion. So we had a steady growth of capital infusion. And just to get a pulse, we sort of captured the cross-sectional time series variation. We see that it is the top 5 banks, State Bank of India, IDBI, PNB, Punjab National Bank, Bank of India, Central Bank of India. So the top 5 banks account for about half or 51% of the capital infusion. Now, the relevance of our study, why is it relevant? I think our study reframes this question of capital infusion stability in the context of emerging markets. There has been a significant growth of emerging market debt. A lot of that actually has happened through foreign debt issuers of non-financial companies, as was pointed out on the panel, and that in turn has increased the exposure for the local banks in these emerging markets. And in particular with respect to India, because India has witnessed significant policy and regulatory changes. There's been a high NPA problem that has, where the media has been very vocal about it. Rajan Acharya's and Gurdeep Patel's recent books also highlight the NPA problem, increased leverage on the bank's balance sheets, and finally, significant policy changes we have witnessed in the Indian landscape. So the two related papers to us are Acharya Kulkarni, who actually look at how flight of deposits to public banks has happened. So during the crisis, government guarantees actually imply that the vulnerable state-owned banks actually have a greater access to credit, and there has been a flight of deposits from private banks to state-owned banks. And that in turn made the private banks vulnerable to crisis. Another paper that is very closely related to us is Banerjee et al., who looked at the Tarp impact on stability in the US context. Tarp, as you know, was the GFC-related financial capital infusion that happened, and they found that it actually reduces systemic risk for larger and safer banks and those in better local economies. And the primary channel it happened was through capital cushion channel. Both these papers have looked at the capital infusions through the lens of GFC, and we sort of go beyond that. So in this paper, we document 3 results which we think are important or interesting, rather. The first result here is this, that in the Indian context, we find that the capital infusions in general are associated with improvement in default and systemic risks in treated banks versus the various controlled banks we choose. However, the large capital infusions can exacerbate such risks. And in particular, we are looking at the systemic risk of the distress beta or capital shortfall measures. So this in turn indicates there's a moral hazard and risk-taking behavior happening for the large capital infusions in the Indian banks. And these results are implemented through the DID framework and sort of are robust to endogeneity. The second important result is how these capital infusions actually have worked during the macro stress periods. So what I mean by macro stress is those 3 highlighted periods, 2010-11, 15-16, and 17-18, where there was a massive spike in capital infusion. And the top graph captures the year-to-year changes in capital infusion. And as it turns out, the latter 2 periods, 15, 16, 17, 18, were also the times when there were a lot of interesting regulatory changes happening in India. The first one, 2010-11, was mostly related to an auditing accounting issue. The bottom line here is this, that these 3 periods saw a massive surge in capital infusion. However, the latter 2 macro stress periods, 15, 17, 17, 18, actually in those periods, the large capital infusions actually helped lower the systemic risk, right? So here the results are in line with the US top results. Whereas we don't see any such capital infusion happening in the first period, which is accounting related. So what is the takeaway? The takeaway here is this, that while large capital infusions can exacerbate the default and systemic risks of the treated banks in normal years, these actually are associated with improvement in such risks during the macro stress period. So we have this interesting result that the large capital infusions can be bad generally, but they seem to be doing okay in the macro stress periods. The third important result is the short-term network effects we witness following capital infusion. So here we present an event window centered around period 0 being the period of capital infusion. So you see that post 0, the systemic risk measures actually plummet. So what that means is the treatment sample here, what indicated in blue on the left side, distress beta, refers to the banks which are actually getting capital infusions. So the MES, or the distress beta systemic measure, actually plummets after the capital infusion, which is a good thing to happen. But at the same time, we also see that other control samples, that is private banks and NBFIs, also experience a fall in the systemic risk. And that is what we mean by spillover or network effects. We see the same thing happening in the capital shortfall too. In fact, the NBFIs, the public NBFIs, also see a downward drift in the capital shortfall along with the treatment sample, which is experiencing it. So the key takeaway is that there is a short-term network effect in that when the capital infusion is aimed at the treatment banks, the other banks in the system seem also to benefit through the plummeting of their systemic risk. So finally, what this implies is that large infusions have short-term positive externalities in terms of network effects, as I've shown you there in the previous slide, but yet could induce moral hazard-related excessive risk-taking by banks, especially during non-stress periods. So it is this interesting dichotomy that our paper gets into. So finally, what is the contribution of this paper? Well, I think this study examines the effect of capital infusions on financial stability using the unique setting that we have in India of non-crisis versus crisis-driven infusions. What I really mean by that is if you look at the US data, for example, Tarp is the most widely cited large capital infusion that happened during the GFC. And there was a massive infusion, about $200+ billion that happened during the GFC. Whereas in India, we see a constant capital infusion happening year after year. And you sort of sum it all over in the last 10, 11 years, it's close to $40 billion. And these infusions can happen even during calm or non-stress periods, as they did happen in a few stress periods. And that actually provides a unique setting to execute this study. The two policy implications that come out of our study, one being that the government guarantees imply trade-offs, as we know, in a theoretical sense, where the government is actually trying to balance two effects. One is the effect of guarantee on the probability of bank run versus the increased probability of sovereign default. Our study actually provides a lens to sort of understanding this calculus in a crisis versus non-crisis setting that is unique to India. The second important policy implication is really about, it provides a lens to understand this optimality question that I pointed out in the previous slide with respect to positive network effects and moral hazard calculus. What I mean is that large infusions actually have short-term positive externalities. On the other hand, they could also induce moral hazard, excessive risk-taking. So when we say large capital infusion, what I really mean is that histogram. On that histogram of capital infusions, we're looking at anything above the median value of $125 million as being the large capital infusions. So how am I doing in time? Okay, the data comes in various forms, various sources. A lot of this capital infusion data is publicly available. We take it from the CAG report. As I said, multiple databases are intersected. The key thing is how we sort of build the treatment versus control samples. So treatment sample here refers to PSBs, the public sector banks that actually receive the capital infusion. Those that do not receive the capital infusion, the public sector banks, we treat them as the first control sample. And likewise, we'll go down the list where private banks, NBFIs, public and private, are also constitute our control samples. We are sort of using the pool control sample here because the sort of PSM becomes tricky, and I'll get into those details. So overall, we have 81 banks in the study. The banks, public plus private, we have 40, 23 plus 17. The NBFIs, we have overall 41, that is 15 public and 26 private NBFIs. We take the top 26 private NBFIs in the study. Now, the first so this paper is really executed through 6 hypotheses. We have 2-3 hypotheses still in progress stage, so I'm going to talk about the others. So the first 2 hypotheses are really about how the capital infusions are actually impacting the default and systemic risks. And so I'm going to show you a few sort of motivating pictures, graphs here, where we first present the PD evolution, probability of default evolution in an event window. So 2 things that need to be taken away is how the event effect and spillover effect are happening. So we have the probability of default on the left panel presented for the treatment as well as the control sample. So you can see right away that the treatment banks here, the ones which are receiving capital infusion, have a huge, much higher PDs compared to the rest. And in fact, the probability of default goes up after capital infusion, not down. It takes about 2 quarters or so for the PD to sort of go down. Remember, we're only doing this 2-3 quarters pre and post because capital infusion in India happens every 4 quarters roughly at the end of the financial year. So this is a sort of 2-3 quarter event window that I'm focusing on. If you take the same graph and then scale it to this common starting point, you see that the idea that the PD sort of goes up until about 2 quarters and then subsides. But then you also see that the NBFIs, the shadow banks, are actually becoming very risky for whatever reason post capital infusion, while the others actually sort of go down in their PD. And the similar sort of effect gets reflected in the distance to default, where the distance to default on the left panel is the bottom for the treatment banks, showing how risky they are. And the right panel shows how the distance to default actually is very high for the treated banks, but then they sort of slowly improve as the capital infusion begins to take effect. So it's like a patient who is getting a drug, and the patient is sort of getting better after the drug is administered. Then we get into various systemic risk measures. In particular, in this version of the study, we have results on the MES, the NS risk and COVAR measures, and the network risk that we use in Das et al. Paper is also going to be is also in progress, in the next version. So just to sort of get a feel for this, what I want to highlight here is how the systemic risk measures evolve. So again, the idea here is this, that seen this before, after the capital infusion, the risk sort of plummet, which is a good thing. The systemic risks go down, not only for the treatment bank, which is in blue, but also for the other control banks. On the right-hand side, so in this case, we are actually looking at the N risk here. And what the N risk shows is how capital shortfall is actually decreasing for the treatment bank. But interestingly, the capital shortfall for the public NBFIs is also decreasing, showing a positive network effect. Again, this is a short-term effect of capital infusion. So I'm probably going to have 2-3 minutes. So the main workhorse is this DID panel regression, and where we have interactions of the treated and post, not only the beta 0, but beta 1, which is a triple interaction of treated times post times the infusion size dummy, larger versus smaller infusion. So the summary of these results is basically this, that the treatment effect is significantly positive. So the treatment banks have a very high default risk, but sort of low systemic risk compared to the control samples. Post-infusion, the default risk plummets, systemic risk does go down, but it's a sort of weak effect. But the strong effect is actually there for large infusions, where we see a significant drop in default and systemic post the infusion. Then if we go to the DID effect, we actually see negative and strong effects. So basically, post-infusion, the treated banks are doing well in default and systemic risk as they drop. But finally, when we interact that with large infusions, we see a big moral hazard problem in that large infusions are actually accompanied by increase in default and systemic risk at the end of the day. Okay? So that is a sort of a result. Then we actually probe this a little more into endogeneity. And in the first stage probe, we use an instrumental variable called CF beta. And that sort of fits into the panel discussion today, because what we mean by CF data is a sort of responsiveness of individual bank firm returns to net aggregate capital flows, to use those betas as an instrumental variable that actually seems to work well in the same context. And the results are still sort of robust. Let me cut through the others quickly. So the systemic risk channels, we have preliminary results, and the results show that a lot of these effects on the capital infusions on the systemic risk is actually working through leverage. It's the leverage why either systemic risk goes up or goes down. And to some extent, the operational, the idiosyncratic risk associated with the cash flow of the banks also play a role in that. Now, let me just tie this up in 1 minute. So the counterfactual stories, the big question is, what would have happened had banks not been bailed out, right? So how do we actually compare this? Well, here we actually present the time series plots of all these measures. So what I want you to take away from this is, as you could see over time, the last 11 years, how the PDs of the banks, so treatment banks, is still very high, no doubt, compared to the others. But if you sort of scale it, you see that in the more recent past, the blue line sort of tapers off, but what you see where the risk is high is the shadow banks. You can see the brown and yellow lines, which sort of indicate the PDs of the shadow banks being relatively very high in the recent past. So it's possible that these PDs of the banks are very high, public sector banks, but probably it's because of the capital infusions why they're tempered down in the recent past and why the NBFIs or shadow banks are actually having trouble. So similar story goes through the other systemic risk measures, where we see over time, the systemic risks of the treatments are actually much lower compared to the controls. And in fact, you see that the shadow banks actually, again, are becoming very risky, even in terms of systemic risk. So had the public sector banks not been bailed out through capital infusions, maybe they would have ended up the way NBFIs are. So this is sort of counterfactual, sort of saying that maybe in the long term, the banks are actually, having lower systemic risk as of now. Now, I'm almost done here in the interest of time. So the summary then to take away here is this: the capital infusions in general are associated with improvement in these risks, default and credit, systemic risk. But however, large capital infusions can be risky, can exacerbate the risks in the system, supporting moral hazard argument that banks know that they're going to be bailed out, so they are taking more risks, and that's exactly what we see in the data. And we see, however, for the macro stress periods, the capital infusions can be helpful in lowering systemic risk. It's a similar result we see in the US data too. And we also emphasize that there are strong positive network effects in that if you bail out treated banks, you're actually helping out other banks in the system. And overall, our literature sort of adds to this sort of regulatory framework that is of interest in emerging markets. Thank you so much, everybody. I hope I'm
Thank you, Madhu. Thank you. Very nice presentation. Now, if you stop sharing the slides, Sanjeev Das can start sharing his slides. Sanjeev is from University of Santa Clara. He's going to be the discussant.
Thanks, Kos. Thanks to Tirthankar and everybody at the NSE as well for hosting this conference and for inviting me. I'll try and get through this discussion in time, Kos, and hopefully shed a slightly different picture as a complement to what Madhu did. So the paper is really interesting because it's really about repeated government intervention, which, as Madhu pointed out, is different from what happened with Tarp. And this is almost like you've got a bunch of children and you're trying to figure out, okay, some of them need help, and how much help should you give? And should you give too much help versus too little? And I think the paper does a really nice job of answering those questions. The data set that's available also is amazingly rich because it covers a wide period of time, almost up to the current day. And so I think it's certainly a positive to be able to look at that data. So the two big results initially that they find is that capital infusions definitely help lower both individual credit risk and systemic credit risk. But if you look at the banks that actually receive assistance, because all of them don't get assistance, ex ante they have higher default risk, and all these banks do experience decreases in credit risk. But the ones that get larger infusions, because in some cases the infusions are much larger, might actually experience increases in risk. And these come out very nicely in the different regressions. What I'll try and do in this discussion is actually point out how there's a theoretical underlying model that we can use to actually understand the empirics of the paper. And so my goal in this discussion is more to try and say, what's the theory that might actually be sitting behind this entire empirical exercise? Also, what is interesting is, as Madhu pointed out, that when you actually help the weak banks, there are spillover effects that actually help the other banks as well. And so these network effects should show up. And what I'll try and do also is provide a theoretical structure in which these network effects get transmitted. The other interesting aspect of the paper is that COVAR measure and the MES measure actually go in different directions. And spend a lot of time on that. But these measures are diametrically different from each other, and I'll try and point out why they're different and why the empirical result that they actually get does make sense because of the difference in the way these measures actually operate. The other interesting result in this paper is that when you get to bifurcating the periods of time where infusions take place between macro periods, where there's very large amounts of macro stress, and normal periods, in the macro stress periods, policy interventions generally tend to be much more successful than in the other periods across the board and don't have these moral hazard effects. And finally, obviously, any capital infusion program does increase sovereign risk, and that could also be measured. As a relief against this, Madhu did a comparison of Tarp, and Tarp was a much larger program, and it had a very diversified base. So it's different in two ways. One is it was a one-time thing compared to what we have in India, and secondly, it was quite diversified. It wasn't just the financial services sector, but it was automotive, credit, housing, and insurance. And so in some sense, this study is actually differentiated from all the studies in Tarp, not just because of the repeated nature of infusions, but also because it focuses on one sector versus a wider range of sectors. And so the effects might be very, very different. And we're asking really here in India, if we just focus on one sector, can we actually help the economy? The other difference is that in Tarp, the feds actually managed to collect quite a good return on this. And the payback to the US government was fairly lucrative. That can be measured for India as well, because we haven't sort of seen that in the paper, but I think it's a nice add-on that can actually take place. The other thing that happened with Tarp is that it was actually a second attempt that actually worked. Tarp actually failed in the beginning because the scheme they originally started with was a reverse debt auction, actually failed because there was a disagreement on price. We don't have that experiment in India, but it certainly is worth looking at alternative methods to the infusion that we have. And finally, the paper could obviously get extended into having a discussion about whether this actually costs the Indian taxpayer or not. So I'm going to jump very quickly into a little bit of a theoretical analysis of this paper. Madhu already pointed out that guarantees have positive effects and that the stability may degrade if leverage increases a lot because people start taking extra risk, like in moral hazard situations. And it also might lead to more expensive insolvencies, which doesn't seem to be sort of a big issue in the data here for the large banks, but certainly is a big issue for the NBFIs. We can go all the way back to Merton, 1974, 1977, to look for sort of theoretical, backdrops. But by and large, everything resolves around leverage and volatility, and that's actually in their paper. I don't think Madhu mentioned it very sharply in the presentation, but they do find these are the two things that drive a lot of the results in their empirical work. So just to quickly review, Merton had this paper in 1977 that actually talks about the cost of deposit insurance and loan guarantees and so on and so forth. And he finds, obviously, theoretically, that both a leverage, which is the deposit asset ratio, as well as the sort of overall volatility over time, these are the two things that actually drive the loan guarantee cost as well as the benefit. You can see down here the cost of deposit insurance obviously increases in leverage and increases in volatility. These are the two things that actually we can look at both for individual banks after infusions are done, as well as for the entire network of banks as well. So just to go back to textbook stuff, this is in fact out of Raghu in my textbook, and this is the Merton model. You basically have the price of risky debt is a function of sort of the debt levels, which are reflected in leverage. So this is sort of leverage down here, and of course, a function of volatility. And this has been embedded in a lot of default risk models like the KMV framework as well. But they all came from Merton. What I'm going to do is actually code this up and show you a little bit of a demo with a program. So you basically have your Black-Scholes model that's sitting in here as part of the framework. And then you can write a couple of small functions that actually take the Black-Scholes framework and give you back the value of the firm, the equity in the firm, the debt in the firm, and finally the probability of default in the firm. But as a very quick summary mathematically, there's a tight relationship between the probability of default and distance to default in the Merton model, and it's just the cumulative normal distribution of a minus distance to default that gives you back the probability of default. So I'm going to actually plug these things into some examples to actually see what happens when we run numbers, both for capital infusions as well as for the risk and moral that we might have. So in a paper last year, we actually built a network model on top of the Merton model. So if I have, let's say, n banks in the system, and all of these banks, we can sort of figure out their probabilities of default from looking at a Merton model implementation on those banks. We can also then look at the joint correlation in the Merton model world between these different banks. Because we do know that the shocks to these banks tend to be correlated. And so we can derive from the Merton model a joint probability of default. And the joint probability of default in the Merton model, which can be empirically extracted, can then be used to define a network, because if banks actually have network relationships, they can be quantified using the Merton model across multivariate setting. So let's just do some quick examples. If I want to work out the probability of default, you can look at these numbers over here. When the volatility for the assets of the bank are 10% versus 11%, so let's say risk went up by 1%, there's a huge jump in the probabilities of default. And so the difference or the increase in the probability of default is about 69 basis points. However, if you look at a weak bank that is a higher level of volatility, even with a 1% increase in volatility, the difference in probability actually goes up by double, which is 139 basis points. So the question is, after treatment, comparing the weak bank versus the other bank is what's done in the difference in the regressions. Can we actually quantify what happens? So this is the original case for the strong banks. In the weak bank, now what we do is we actually add extra capital to it, and we try to see what exactly happens. So when we add extra capital to it, what we get is that there is a drop in PD. It doesn't go up by as much. And so now there's only 102 basis point increase. So obviously, that's the first order effect that you get. What we want to do is take these first order effects, that the univariate effects on individual banks from Infusions, and actually look at the network effect. So here's a model for the network effect. You basically have a vector of probabilities of default from the Merton model for, let's say, all the banks in the system. So this is a 1 by n vector given n banks in the system. We have a network matrix. The network matrix tells you which banks are linked and which banks are not linked. And then we have the same probability vector here for probabilities of default. If I take a dot product of all these three vectors, I actually get a single scalar value. What I've done here is I've taken the Merton probabilities of default for all the banks, weighted them by the network matrix, and got a network-induced systemic risk quantity. And so if the probabilities of default increase, S will increase. But what happens usually when the probabilities of default increase is that the network gets thinner because counterparty risk goes up and banks tend to not trade with other banks. So there's a countervailing effect where the network sort of gets thinner and S comes down while the probabilities of default are going up and pushing S up. So there's some balancing point in between that the government wants to figure out and say what happens to network effects when I do infusions versus the probabilities of default. So I simulated 100 banks, roughly the size of the sample that's in the paper. And I worked out the probabilities of default, which are in the regular range of about 1-2% to all the way to 15% for the bad banks. And then the network matrix gets adjusted. So as default risk in the economy goes up, counterparties start not trading with each other. So the network gets thinner. And what we get is a base level of systemic risk per bank of 0.045. So that's the weighted average probability of default for the economy. What happens if risk goes up? That number almost doubles without any sort of ameliorative effect. So you can see here the volatility is being increased by 10%. The risk in the system goes up. And then the government comes in and makes infusion. So we basically make a 10% capital infusion over here and drop that down again. Systemic risk doesn't go down by exactly the same amount. So this is just a quick model to do this. Couple of quick comments. One is that we can explain a lot of the results by this network effect. Okay, so for example, when the economy does badly and there's some infusions, network effect actually comes down. That's why systemic risk as well as default risk comes down. But then if we make very large infusions because the economy is doing really badly, what we find is that that systemic risk level can actually go up. And that's exactly what Madhu finds. Now, what they also find that's interesting is that MES goes in one direction and COVAR actually goes in the other direction. And there's a reason for this. Maximum expected shortfall has a different directionality because it looks at how is an individual bank affected when the economy is in trouble. COVAR is actually, if the bank is getting into trouble, how does it affect all the other banks? So these two systemic risk measures actually go in completely opposite directions. And what's interesting is that Madhu and co-authors actually find very different effects for these two measures in their paper as well. The other thing is large infusion banks. Basically, what we find is that the different regressions show that bigger infusions are more vulnerable. Those banks that are getting bigger infusions are more vulnerable. But one of the things I would like to point out is that there's a matching that's done. It's very hard to do propensity score matching here because the big banks are not like any of the other banks. And so it's pretty hard. And the matching is done only on size. And they should also be done basically on volatility to get good results there. Finally, so these are policy questions that I think can be answered by the paper and the extensions that can be done. First of all, ex ante, what happens when we have this repeated regime of infusions? What is happening to risk-taking ex ante? We're sort of looking at risk-taking ex post right now. Can we actually predict follow-on infusions? Is the government throwing good money after bad? And I think there's enough in the data for the authors to actually be able to look at that. Should matching be done on a policy basis? In the US, for example, compensation is done on a matching basis. Wall Street banks have a matched bank, which is kind of well known, where they follow for compensation and for other reasons. Maybe policy directive to do that is possible. The non-monotone results over the next 2, 3, 4 quarters, these might be seasonal and something to look at. Can we establish a causal relationship? Right now, we're sort of intuiting that moral hazard is the reason why we get this effect for large infusion banks. But I think there's a causal model behind there that can also be estimated. And finally, what is the final policy implication? Are these good? Should they be repeated? And so on and so forth. And I think the paper could be a little more bold about making those statements. I think Madhu's being just careful about that. All right, I'll stop here, Coase.
Thank you, Sanjeev. Very insightful discussion. Madhu, we're going to have a general discussion of the paper. Do you want to start with making some responses to Sanjeev?
Yes.
That also applies to all the co-authors, Vijaya and so on. Yeah, and Shankar. Yeah.
Yeah. So thank you so much, Sanjeev. I think it's fantastic and very insightful as always. So 3 quick responses. I think the model that Sanjeev provided, network model with the Merton plugin, I think is immensely useful to justify our results. So thanks, Sanjeev, for that. The second thing is really about data matching. It's absolutely true. It's hard to get a PSM going in India because the public sector banks are so vastly different compared to any of those private or NBFIs. So as of now, we are only doing pool controls because we have a smaller sample. We only have like 20 public sector banks. So, but we can certainly do some matches based on volatility and other measures that Sanjeev indicated. The thing is about moral hazard. Yes, I think we can do some more empirics. And in fact, we are in the process of gathering data to exactly do all those channels and pin down the channels more. The final thing is the policy implication. Yes, I've been careful and cautious on that. Okay, yeah, great.
Okay, great. Any other comments from the authors, or I'll just open up to some questions which have come up. Okay, for the discussion, the panelists can just ask the questions. Yeah, they can unmute themselves and ask the questions. So I saw some questions in the, and then the attendees can raise their hands, and we're going to call upon them to ask their questions. Rama, go ahead.
So thank you, Madhu and Sanjeev, for a very, very interesting paper and discussion. I have one quick question that Sanjeev will have already touched on, but his very dense paper, I'm not sure if he actually answered it. Madhu finds a support for the moral hazard argument, which is not, unusual. But what I found unusual was the suggestion that network effects, he found that they actually help, the bailout helps other banks because of the network effects. Doesn't this go against the moral hazard result?
Yeah. So, so absolutely. So I agree with the. So there are these trade-offs that we come across. So that's why I think this. So we point out this calculus. So I don't know. So there's sort of an optimality calculus. The data shows that such a trade-off exists. That on one hand there is a moral hazard, the other hand there is a positive network. So it is something we need to drill more into.
Hi, Madhu and Vijay and co-authors. This is Prachi Deoskar from ISB.
Yes.
Hi, Prachi. How are you?
Hi, Kos. How are you? Hi, Sanjeev. Good to see everybody.
Yes.
Likewise. Yeah.
So my question is about the network effect, because I think as everybody here has discussed, everybody's finding that the most interesting part probably.
Yes.
So my question is this, and you may not have had time in the short presentation to talk about that. Do you actually construct network among banks? Right now, from what I understood, it's you're showing the effect on the control sample and saying that is due to network effect.
Yes.
So it could be simply that both are changing for exogenous reasons, and you're attributing it to the capital infusion.
Absolutely. So the answer to that is absolutely right. So right now we don't have a network model. In fact, that's something in progress. I have a paper with Sanjeev which actually looks at the network construction. It was funded by NSE-NYU a couple of years ago, as you know. So we are actually implementing that for this data. So I'll give you a more precise answer. But right now, as you rightly said, we are sort of inducting this spillovers simply through the large, so through the regression we see DID, that post capital infusion. So basically, large capital infusions seem to have an effect where the systemic risk and PD is sort of going systemic risk downward trend after capital infusion. So that is what I mean by crossover, spillover effects. But you're absolutely right. So I need to be more precise. I need to build those measures, and that we actually going to be implementing in the next round.
Thank you. Any other questions? Did I see a question from Rinal? Any other questions from the panel?
I have one other very quick question, Madhu.
Go ahead, Rama.
Yes.
How big is your match sample? I was just curious.
Yes. So actually, we are not doing matching here, Rama. So basically, we are sort of taking, so we got about 23 public sector banks, about 20 public sector banks. Roughly about half of them get capital infusions, if not more, every year. So then who are the controls? The controls are private banks and NBFIs. So we got about 12 or 13 private banks. We got about 15 or 16 public NBFIs, and we take the top 25 private NBFIs by asset size. So it's very hard to do the PSM, like perfect matching, because of the vast differences between the treatment sample of PSM, public sector banks and others. So right now, because it's a small sample, it's only got like 20 firms in each. So we're sort of using the pooled control sample, making sure that the control samples are large firms, so that at least they're comparable in size to the public sector banks we have.
Do you exclude SBI, or is SBI included?
Yeah, I know SBI is there. It's a big elephant. It is there. But we can, you're right. So we can actually just do the results only for the top 5 banks.
I think the SBI would just take the sum.
Yeah, exactly. Yeah. So and SBI gets about 15% of the public infusions too. So we can take that out. But definitely, so these are robustness checks. We didn't have time to do it, but we are doing it. Thank you.
Yeah, Kos?
Any more? Yeah, go ahead, please.
I thought I would just respond also on Madhu's behalf to some of the questions. So one of the things is that the network effect can be quantified, and in fact, the data is available because you have at every quarter what the probabilities of default are, And the question really is, can we construct a network matrix for each quarter, which in fact we do. And then what you do is you hold the network matrix constant and see how the changing PDs after the infusion affect the total score in that formula I had. And then you hold the PDs constant and change the network matrix and say, what happens if the infusion increase connectivity because now counterparty risk is lower, and you can actually tease out the difference between the two. So I think there is plenty of data available to actually break down how much of the effect on systemic risk is coming from the fact that just the PDs came down, and how much of it came from the fact that the system actually changed in its linkages.
So Sanjeev, do you have a sense that there's some kind of a U-shaped relationship, or we can come to some idea that a certain amount of bailout capital will not affect the moral hazard, but then you go beyond that and suddenly you're in the realm where regulators don't want to be?
So the moral hazard is a slightly different question, because there you can work out how much the probability of default should be after the infusion without moral hazard, and then you look at actually what it turned out to be in the data, and if it's higher, then you can sort of say that the difference between what it should have been after the infusion of capital and what it actually turned out to be is attributable to sort of the moral hazard risk. Also, to answer your question, Rama, about SBI, I did that exercise of the network. We've actually drawn this network for the Indian banks. And what's interesting is SBI actually doesn't have a lot of network linkages. It tends to be a closed internal system. And so it doesn't actually contribute a lot to systemic risk because it's not sort of, spilling over on a lot of other banks, whereas a lot of the other banks tend to be much more networked, and that they might actually pose a bigger risk because they're connected rather than big.
Very interesting.
Another quick answer to Rama is the network effects on pre-chart 2 is the network effects are mostly short-term, whereas this risk-taking and moral hazard are more long-term effects. So it's like a patient who's getting a drug every day, right? Every day, so he feels better, but next day he needs a drug again. So that is like the sort of network effects, and every other patient feels better too. So that effect is spillover effect is only short-term. But in the long term, what we see is actually that the risk-taking sort of takes over. So just by helping treatment banks, government cannot sit pretty thinking that all other FIs are going to be okay. That's not possible. It's only in the short term we see these spillover effects.
So the fact that these bailouts helps the other banks is purely short-term effect?
Yeah. So we're only looking at like 2-3 quarters. Whatever I'm showing you is 2-3 quarters. But if you look at a long time span, they're not moving necessarily. They're not co-integrated. They're not moving parallelly, right? Yeah.
That makes sense.
We're going to see Madhu's paper in the COVID crisis because vaccinations are coming like infusions. We've got all these network effects going on.
Okay, any quick questions because we have to move on? Any other questions from the panel? So I just want to say this has been it's a very interesting and complex paper. Sanjeev, you contributed a lot of ideas, so I hope you guys keep in touch. And then we have a paper on liquidity and fragility and all kinds of wonderful things coming up. Let me introduce you guys. So the next paper is a research paper supported by the grants. It's portfolio inventory risk of liquidity providers, frictions and market fragility. So the paper is by Pradeep Yadav, who is at University of Oklahoma, Roman Cohen, University of Warwick, and Lancaster University. Vikas is going to present the paper. Vikas, you have 20 minutes.
Thank you. Thanks for the opportunity to present the paper. So I'll first start off with some basic definitions, institutional layout, and then get into the paper. The liquidity that we are referring to in this paper is the transactional form of liquidity, the ability to trade cheaply and efficiently, and liquidity traders tend to buy and sell on their own account and thereby facilitate a transaction flow. So this is the kind of liquidity that we are, of course, talking about. Now, the institutional setting is as follows. In the older dealer markets, such as the LSE or NYSE as they used to be, liquidity providers were obligated to provide to post bid and ask quotes, but that's not the case anymore. In today's modern limited order book markets, most traders tend to provide liquidity. Anyone and everyone can, and these are referred to as voluntary liquidity providers because they're providing liquidity without any necessary obligation to do so. And we refer to these voluntary liquidity providers as VLPs, and those are the people we are studying in this paper. Now, the basic business model of a VLP is not too different from a dealer, as in the VLP earns a spread between buying and trading between the buying and the selling price, carries inventory exposure, and we are focusing basically on these professional VLPs who invariably tend to go home flat. And when we say they tend to go home flat, what we mean is, although they trade a lot, at the end of the day, when they close the books, they usually do not carry much inventory home. Overnight inventory is approximately zero, almost always. Another interesting aspect of these VLPs is the fact that they not only trade a lot in a given stock, but also that simultaneously they tend to participate in multiple securities. So the fundamental question we are asking in the paper is their trading in one stock influenced by their positions in other correlated securities they may hold in their portfolio? And as per Hohenstall 1983, which is the seminal reference paper in this area, the answer is yes, it should. And this paper, to a great extent, informs us and drives our hypothesis in the paper. And it's not only that the trading and liquidity provision of a VLP is influenced by their holdings in correlated securities, but in extreme cases, the management of these liquidity providers' correlated portfolio inventories could arguably be a significant source of contagion and liquidity fragility. Especially because in these cases, liquidity shocks from one security could propagate to other securities through this channel of portfolio inventory management. And we are investigating these kinds of cross security implications of VLP's portfolio inventory management in limit order book markets as the NSE is. Now, as intuitive and theoretically appealing the predictions of Hohenstall 83 are, the net effect of correlated securities is not entirely obvious. The only other paper to perhaps directly investigate the Hohenstall model, empirically test the Hohenstall model, actually found results not supporting the predictions of Hohenstall. And this is the Nayak and Yadav 2003 that I'm referring to. They investigated dealer inventory management in the LSE market in the old structure as it was. This is pre-1997. And what they found is that these dealers tend to operate as if inventory positions in correlated securities didn't matter. They appear to be overlooking those inventory positions and only concentrating on inventory positions in that particular stock. And they argue that this happens purely because of the organizational agency costs involved in managing coordination across traders, and also because these were old over-the-counter markets where communication was very difficult, especially real-time communication, and most of the trading was telephone-based. And to add on top of all of these things, also the issue of affirmative obligation also constrained them in terms of inventory management. Now, most of these things are not the case anymore. Real-time communication is not an issue in today's electronic markets. And our voluntary liquidity providers, as the name suggests, of course, are not obligated to provide liquidity. However, given that these are voluntary liquidity providers, they have complete flexibility in wanting to, if they want to deviate from a pure market making strategy and also indulge in information driven or unplaced directional bets. Now, if this is the case, as studied by Pasquarello and Vega 2013, Chesper and Foucault 2014, it could be that VLPs could learn about a security's fundamental price from the prices of other securities with correlated returns. And in such a scenario, they could potentially take similar positions across correlated stocks rather than offsetting positions as predicted by the inventory management model of Hohenstall. Therefore, establishing the net influence of these correlated inventories or positions in correlated securities is not as straightforward. It's not as obvious as it would suggest, and hence it requires an empirical analysis, which is precisely what we actually do in this case. Let me give you a quick preview of the results. I don't know if I'll have time to go through them in detail, so let me just give you a preview so you know where we are coming from and what our contribution might be. What our results indicate is that in accordance with the predictions of Ho and Stoll, we find that in our limit order book markets, the voluntary liquidity providers manage their inventory on a portfolio basis. So their positions in correlated securities affects their trading in a given security. And they don't seem to be doing this on a stock by stock basis. Next, we find that VLP's trading and order placement strategy is also significantly influenced by positions in correlated securities. And consistent with the information story or the information driven objectives, what we find is that the offsetting influence of correlated securities is less pronounced for VLPs whose trading could most probably be driven by information strategies. More specifically, what we find is that VLPs who you would expect to be most informed, for them, the offsetting influence of correlated securities is less pronounced. It's not as severe as it is for other VLPs. Finally, we find that securities experience greater cross-security price pressures and episodes of market stress when VLP positions in correlated securities are large and undispersed. Now, this is a running theme that you'll see in quite a few results, indicating that the liquidity effects of portfolio inventory management are especially severe when VLPs hold large, as in the magnitude of correlated positions, sorry, when the magnitude of inventory portfolio is large, and when VLPs hold very similar positions across different stocks. If their portfolio inventories are very similar, then the cross-security price pressures and effects on market quality are especially similar. In terms of contribution, I think the primary contribution of the paper is, of course, to the inventory management literature. Now, there's a very vast literature on the effect of dealer inventories on dealer trading behavior, starting from Madhavan Smith 1993, Manisranma 96, Ansh Naik Vishwanath in 98, all the way to Naik and Yadav 2003, and there are many other papers here as well. Now, this entire literature is on on the effects of stock level inventory. But when you come to portfolio effects of inventory management, there is very, very little to go by. The only paper that directly investigates this, and I've discussed this, is the Naik and Yadav paper. And our results are in stark contrast to those. We get to cleanly test the predictions of the Ho and Stoll model for the trading of liquidity providers, and our results turn out to be strongly supportive of the Ho and Stoll model, as opposed to the Naik and Yadav paper that I've discussed, find results contrary to that. Now, the other contribution is to our understanding of how portfolio inventory management affects market liquidity. Now, here again, most empirical studies that have examined liquidity in limit order book markets have usually ignored inventory costs. The focus is more on asymmetric information than anything else. And those that have examined the role of inventory costs on liquidity have typically considered, again, only stock level inventories. A good example is the Hendershot-Manquil 2014 paper, where they look at how inventory management creates price pressures. What we are doing is we are exploring, and we show that how VLP inventories are significant and incremental determinant to limit order book market quality. We find more specifically that wider bid offer spreads and large price pressure effects with higher magnitude of VLP inventories, portfolio inventories, and lower dispersion of portfolio inventories across different liquidity providers. Another contribution of the paper is to our understanding of determinants of liquidity fragility in limit order book markets. Now, there's been a great amount of regulatory concern that liquidity in limit order book markets is not entirely reliable, not dependable, especially during periods of market stress. The reason, of course, is because liquidity in these markets is provided by voluntary liquidity traders who might stop providing liquidity as and when it suits them. Yet we know very little about the determinants of this liquidity-induced market fragility in such markets. Papers that study firm-wide or portfolio inventory effects have typically focused on dealer markets or markets such as the NYSE and the NYSE specialists. But the problem is NYSE specialists are obligated to provide liquidity. So understandably, these papers are not well suited to answer questions of liquidity-induced fragility in limit order book markets. Because the main problem there, if there is the fact that liquidity is provided on a voluntary basis, and the markets that have been studied so far in a portfolio context, you invariably look at intermediaries who are obligated to provide liquidity. And the papers that do study inventory effects in limit order book markets typically have examined only stock level inventories. A good example is Kumar's paper with Ambert in 2016, Kerlinko et al. 2017, the Getminsky et al. Paper in 2018. These papers, the message that comes across is that VLPs turning from liquidity providers to liquidity demanders due to unsustainable levels of inventory imbalances is an important precursor to episodes of market fragility. Now, what our paper does is that it builds on this literature, it controls for the effect of stock level inventory and shows that there is a significant and an incremental effect of inventory positions in correlated securities. So one security is influenced by liquidity providers' inventory and inventory risk exposures in other securities in their portfolio. Our results also show that along with stock level inventories, large and correlated portfolio inventories significantly increase the likelihood of market fragility. And when I say market fragility here, we measure market fragility as episodes of extreme price movements, extreme ends of the return distribution, and as episodes of transitory jumps in stock return. The data that we employ to conduct our examination is data from the NSE, gives us data on 50 stocks that make up the Nifty index. This is from 2006 3-month data. Now, the data has all the information that you would require to reconstruct the order book. But most importantly, it provides us data on trader inventories as well, on trader identification codes. Now, because we can identify traders, we get to track their inventories over time and across stock, which is crucial to the investigation that we are carrying out here. Now, of course, this is 2006 in India, so there wasn't any algorithmic trading as such. It was prohibited in this period, but we have some expectations that the results would be stronger, if anything, if it were to be tried in a period with algorithmic trading, and I could get to that if we have time. Now, the data has about 1.2 million traders in the data set, and arguably all of them could be liquidity providers, but of course it's not feasible to study 1.2 million traders in liquidity inventory management. So what we do is we restrict ourselves to the most active VLPs. The base case is set for the most active 100 VLPs. But the results are not sensitive to this magical figure of 100. We repeated the analysis with 150 and 300 VLPs, and the message is roughly the same. Just to give you an idea of the VLPs that we are studying in the base case, these 100 VLPs account for about 40% of all limit orders, 57% of trades, 50% of trading volume. They invariably do not carry inventory home. So as a ratio of how much they carry home to how much they trade in the day is practically zero. Most of these VLPs are exchange members. 17 of them are financial institutions who are not exchange members, and the remaining 10 are individuals or hedge funds. A summary of some of our main results is as follows. The first and foremost result that we have is that liquidity providers' portfolio inventories tend to mean revert at a significantly faster pace than their stock level inventories, 30% faster to be precise. Now, what does this mean? Well, it means that VLPs appear to be more concerned and more astute in managing their portfolio inventories than their stock level inventories, because they're looking at the total net effect of their correlated positions rather than just the positions they have in a given stock. And what we have here is a graph which shows the distribution of the differences in the rates of stock level and portfolio level mean reversion. And what this is showing us is almost for the entire distribution, the rate of mean reversion for portfolio inventories is that much faster, that much higher than it is for stock level inventories. And the mean reversion in portfolio imbalances is especially greater when portfolio inventories are larger. So when VLPs have larger the inventory imbalance they have, the faster is the correction. The more volatile stock returns are, faster is the correction in portfolio inventory imbalances. And the correction is especially faster when VLPs have suffered abnormal losses in their portfolio holdings. Because now they are not as it's not as feasible for them to hold on to large positions, so they revert to their targeted inventory levels that much faster. And interestingly, VLPs whose trading is more likely to be driven by pure market making reasons, the mean reversion is significantly faster. So the more likely a VLP is to be an information-driven trader deviating from pure market-making strategies, slower is the rate of mean reversion. And consistent with this, we also find that VLP's portfolio inventories influence their order placement as well. So a VLP is significantly more likely to place a sell order than a buy order in a stock to offset excess positive correlated inventory exposure in the rest of the portfolio. Next, we study the effect of portfolio inventories on market liquidity. Specifically, we look at bid-offer spreads. And what we find is portfolio inventory levels, as greater the variation in portfolio inventory levels smaller the variation in portfolio inventory levels across different VLPs, and larger the magnitudes, worse the liquidity is. So the bid-offer spreads are wider when inventories have very similar positions across their correlated securities, and when VLPs have very large portfolio inventories, the bid-offer spreads are that much wider.
Because 3 minutes.
Yeah, thanks. The next result that we look at is the effect of these portfolio inventory imbalances on price pressures. And here again, we find a significant result. And the magnitude of price pressure is also quite economically significant. It's about 5.4 basis points. To put it in perspective, it's about twice the bid-offer spread. So it's pretty massive economically speaking. And again, the effect of portfolio inventories is particularly high when you have lower dispersion of VLP portfolio inventories. The last thing that we look at is the effect of portfolio inventory management on episodes of market stress, looking at the likelihood of market fragility. And as I mentioned, we are measuring market fragility as episodes of extreme price movements and transient jumps in stock returns. What we find is that the likelihood and the number of extreme price movements significantly increase with the magnitude of aggregate portfolio inventories and reduces again with the dispersion of portfolio inventories across VLPs. And the effect is economically pretty strong as well. Just to give you an example, a 1 standard deviation increase in the magnitude of portfolio inventories is associated with an increase in the odds of observing extreme price movements by a factor of 37, transient jumps by a factor of 1.3. So we're talking about fairly significant, economically significant effects. We further do a VAR analysis, and the results are quite consistent with our OLS, our panel regression results, that the number of episodes of extreme price movements increase with the magnitude and reduce with the dispersion of portfolio. So to conclude, what we are basically doing here is we're investigating how trading, liquidity provision, and market quality in one security is influenced by correlated inventory exposures that voluntary liquidity providers may have. Our results are consistent with the story that large and correlated portfolio inventories worsen different measures of market quality, bid-offer spreads, pricing errors, and so on and so forth, and increase the number and likelihood of extreme price movements and transitory jumps in stock returns. So what we're basically doing is highlighting a significant, but more importantly, often overlooked source of market frictions, contagion, and fragility. Thank you.
So thank you, Vikas. Thank you very much.
There you are. I'm Kumar Venkatraman. I want to thank Course and Tirthankar for this invitation. It's really a pleasure to be part of this conference. And clearly, it would be a pleasure over the next year to be meeting everyone in person. I grew up just a few miles from the NSE building, and I would love to visit my usual stomping grounds at the conference. So this is a paper which helps us understand the behavior of liquidity providers. So liquidity providers are market makers in the context of equity markets. They are dealers in the context of the fixed income market. And we had a panel this morning on the corporate bond market. And clearly, the insights from the study apply more broadly to markets outside the equity market that this study focuses on. So what is this paper about? So there's been a lot of work done about the behavior of dealers. And this goes back to theoretical predictions from Amihud and Mendelssohn and Ho and Stoll. And the main idea is that dealers care about their inventory risk. So for example, if a dealer takes a large position in, say, JP Morgan stock, then as they make markets in JP Morgan in the future, they are trying to adjust their quotations to account for their position that they already have. So for example, if they have a positive position in JP Morgan, they would try to sell their position, which means that they would reduce the ask and lower the bid. And this behavior of shading their quotes as well as shading the depth that they are willing to provide results in a mean reversion in inventory because counterparties arrive to take the inventory position away from them. So this has been documented in prior studies. We know that inventory risk is an important component of the bid-ask spread. So inventory risk is seen in terms of security characteristics such as trading volume. So if you take the case of small cap stocks, for example, they tend to be associated with one-sided order flow. And dealers are more careful about building positions in small cap stocks because they're worried that they may take on a position and they may have to hold it for a while. And so they're ideally, if you're a market maker, you want to take a position and get out of it as soon as possible. So we know security characteristics like trading volume affects the bid-ask spread through the inventory risk channel. We also know that market conditions affects bid-ask spreads. Again, because periods of high volatility implies that the inventory that a market maker holds, if they are risk averse, it leads to a higher price risk. And so we find that market conditions affect bid-ask spreads. Then there's been a literature over the last 15 years which deals with this important idea of commonality in liquidity. And commonality in liquidity refers to the fact that liquidity moves together across securities. And one driver of this liquidity commonality comes from the suppliers of liquidity. And the idea is that if there are certain market conditions which makes it more risky to supply liquidity, then each individual market maker looks at these market conditions and they make a participation decision which tends to be correlated. So they tend to sort of withdraw from participating at the same time. And so what this means is that although there's a lot of liquidity in certain market conditions, when market conditions switch, all these liquidity providers, each making sort of an individual decision, withdraw at the same time. And so this results in a drop in liquidity, which is correlated. And this is what is referred to as fragility. And when liquidity supply declines, then it leads to excess volatility because you don't have counterparties to participate with. So this is a fantastic line of research that have been looked at in many of the empirical papers that I list here. Pradeep has done some important work in his prior work with Narayan, so this is where the literature is. But all these discussions so far is looking at how dealers behave when they have a large position in JP Morgan stock. How do they behave in terms of their quotations in JP Morgan stock? So what this paper is doing is taking it a step further, and it's making the point that if you're a market maker in JP Morgan stock, that's fine. But at the same time, you probably have some inventory positions in other stocks. So for example, if you have a positive inventory position in Bank of America stock, and the returns of Bank of America and JP Morgan tend to be highly correlated, then when you make a decision as a market maker to supply liquidity, you are looking at not just the inventory position in JP Morgan, but also Bank of America. So that's really the key idea that this paper is going after, which I think makes a lot of sense. It's consistent with theoretical predictions, but it has just not been looked at very carefully in the literature, in part because there is not sufficiently detailed data to run this kind of analysis. So for example, if you take the TAC data, which is used in many microstructure studies, you have data on transactions, but you don't have data on participation. So we don't know, which dealer is participating, what their market making positions are, and things like that. So this study really uses the proprietary NSE data to implement a portfolio inventory measure based on all the inventory positions of the market maker. And equation 2 here sort of combines these inventory positions based on the correlation of this stock, JP Morgan, with all the other stocks that this market maker holds. And it shows that this portfolio inventory has an incremental impact on dealer behavior, whether it comes to quote shading, whether it comes to bid-ask spreads and depth that you observe in the market, and also the positions of dealers, the network of dealers who make market in the stock, whether they hold positions which are similar or whether it's dispersed. This also has an impact on the fragility and the excess price moves of the stock. So this is a fantastic extension, and I think this is a great line of research, which is very promising. And the authors have been able to show very nice results, given that they have very specialized data to actually answer this question. So what are my main comments? My main comment is that this is a paper that has focused a lot on the breadth of analysis. Clearly, when you have a new measure, it's sort of exciting to take a look at what the research has been done so far and sort of apply it in the entire type of analysis that have been done. And that's what this paper is doing right now. So there's a lot of breadth and a lot of sort of basic results are being examined. But what the paper is perhaps missing at this point is a sort of a deep dive to help us understand these results better. So what I would suggest to the authors is really to think about their analysis in two parts and maybe split up the paper into two different papers and then do a deep dive so that we understand this better. First, I think you can look at it from the perspective of an individual dealer. An individual dealer has a position in a stock. He also holds a portfolio inventory position, which is correlated with the stock. And so just really help us understand what is the economic relevance of these two components. And in particular, study interaction effects and present more cross-sectional and time series effects. That's my sort of first recommendation. The second study that they can write about is really take a few tables from their paper and talk about this fragility risk, which is looking at the network of dealers. So moving away from an individual dealer to the network of dealers and try to understand the position of the network of dealers and how that affects market quality and fragility in liquidity supply. So next, what I would like to do is present some more concrete ideas on how each paper that I recommend can be further expanded. My main recommendation is that the authors, if they have the data, should expand the sample to look at smaller cap stocks. So right now they're studying the Nifty 50 stocks. These tend to be more liquid stocks. But if you go back and look at the classic liquidity provision problem, it's really how do you improve liquidity supply in less liquid stocks? That's really the classic problem. And inventory risk is a big issue in the case of mid and small cap stocks because the order flow is not very balanced. And so if you're a market maker, you don't want to really take a inventory position in a small cap stock because you don't know when you're going to get out of it. So the fact that you have a correlated inventory position in perhaps liquid stocks may actually help you manage this problem better because you may be able to hedge your position. So I think this is a very important idea that they can further expand. I would also suggest that they can provide more interaction effects to help us really understand the importance of single stock inventory versus portfolio inventory. So for example, you can consider under point 2 a situation where in JP Morgan, the market maker has a small or a large position. At the same time, you may have scenarios where in terms of their portfolio inventory, it's small or large. And if both inventory positions are small, then it should have a trivial impact on the dealer behavior. But on the other hand, if the JP Morgan inventory is large and the inventory in the other stock is also large, then you can have either an amplification effect or you can have a hedging effect. And so I think looking at the sign of these inventories and very clearly showing these effects and the asymmetry, I think is important. And then in the off-diagonal elements here, you can see that sometimes JP Morgan may be large and the portfolio inventory may be small or vice versa. And so to study those scenarios and really help us understand what sort of the marginal effects are, I think would be very beneficial. Then I would suggest that the author should take a look at small stocks and really separate it into two groups, or mid-cap stocks, and they're separated into two groups. One group has a portfolio of liquid stocks that tend to be highly correlated. The other group, it may be more difficult to identify such a portfolio. And my prior would be, just going back to Hohenzollern, is that the way in which they would make markets in group 1 would be different from how they make markets in group 2, just because in the case of group 1, they have more levers on how to hedge their inventory. So really doing a case study of these two groups and helping us understand the incremental benefits of this portfolio effect, I think would be very helpful. Similarly, I think a deep dive into market conditions and how it impacts dealer behavior would be helpful. And in particular, I would say that break up the volatility into market-wide volatility versus idiosyncratic volatility. And one can immediately see that market-wide volatility has implications for the portfolio inventory, because market-wide shocks would move the portfolio inventory as well, whereas idiosyncratic shocks will not. And so again, understanding better where this portfolio inventory has an impact versus not, I think will be insightful. Similar comment with respect to order flow imbalance. So you have market-wide one-sided flow in some scenarios versus single stock. And again, studying this will be useful. So these are some extensions that the authors can consider with respect to the examination of an individual dealer. And then when it comes to the second paper that I recommend, which is a very important idea, I think, because you want to look at the network of dealers and understand how they behave when, how bid-ask spreads and market quality behaves when the network of dealers have inventory positions that are in the same direction versus which are widely dispersed. I would say that understanding better the market conditions under which these portfolio inventory positions are in the same direction versus dispersed will be a very nice way to help us understand when fragility risk is higher. So actually, they have a metric here of when the market makers may behave in one way versus the other, and actually modeling it out and identifying these market conditions. I think will be very insightful as well.
Kumar, so, 2 minutes. 2 minutes.
Yes, I'm done, Kos. So to summarize, I think the paper is looking at an important topic. The paper has identified a very interesting new measure, which is portfolio inventory. The measure is motivated by our theoretical models. The measure is intuitive in terms of the impact that it will have on the behavior of dealers. And I think at this point, the authors have presented a number of very interesting results. What I think the paper can do is actually tell us more about the mechanisms that are in play to explain sort of the main results that they have shown, and then in particular expand the sample to mid and small cap stocks. So in other words, there are two key issues that I think microstructure research particularly cares about at this point with respect to this study. One is, how do you improve liquidity supply in small cap stocks? And two, when are market conditions fragile from the perspective of liquidity supply? And I think the paper can help us understand both these important questions quite well. Thank you.
Thank you, Kumar. Very insightful discussion. Would the authors like to respond and before we take up the questions?
Kos, can I respond? Vikas and I have agreed that I'll respond first.
Yeah, go ahead.
First, thanks so much, Kumar, for an extremely insightful discussion. And you presented the intuition of the paper extremely well. And I think it's made it much more clear to everyone as to what everything is about. I think we also very completely take on board your suggestions. It is very important for us to look at mid-cap stocks and small stocks, because that is where the liquidity crunch in relation to correlated inventories would be particularly strong. It is also something which you did not say, and I guess which is very relevant, is the fact that this, while it is very useful in many ways, that the paper is looking at a non-algorithmic area, a non-algorithmic period, because at that time we have no, if you like, confounding effects due to algorithmic trading. At the same time, for it to directly address policy issues in today's environment, we also need to look at the era of modern algorithmic trading. And at present, we don't have the data for either the small stock the small stocks and also for the thing. So we are going to request the NSE accordingly for that data. So that is one aspect. Your suggestion of breaking up the paper into, or suggestion of looking at some of the issues in deep dive are, I think, also very relevant, particularly the issue that you raised, which rung a great resonance with me, given my earlier work on threshold models, is that if it is small, it's going to be a trivial effect, and it's going to be much more of an effect when it's sort of large, and that is where you would have a huge amount of issues. And I think that is, once again, the paper is quite unwieldy at present, so it really would need more like an extension of a different kind. And whether we break it up into how we do it, yes, those kind of deep dive issues are very relevant, and we thank you for some tremendous. So, Vikas, would you like to add on to?
Just a very quick response. Thanks a lot for the comments, Kumar. Extremely valuable. The only thing I'd add is, while we don't have much of a cross section in terms of stocks, because we only have 50 stocks and they're very similar, highly liquid stocks, as you pointed out, what we do have is a cross section of traders. And so what we have started doing in the paper is we have added some interactions on the type of trader in terms of how informed you would expect them to be and so on and so forth. So we're beginning to do that kind of work, but thanks a lot. We'll definitely take that forward.
Thank you, Vikas. Now again, like we did in the earlier sessions, we'll start with questions from the panel, and then we'll also go on to attendees. So if attendees can raise their hands, that would be helpful to locate them. But the panelists, any questions, that'll be great.
Can I also request ask Roman Kozin if he has any points? He's on the call as well.
Oh, absolutely.
Roman, do you have anything you'd like to say, or we just go on?
No, just go on. I mean, I just want to thank Kumar for great discussion. It's fantastic. Thank you very much.
Roman, feel free to join in the discussion. I see Barney has raised his hand. Barney Mishra from XLA. Yeah, go ahead, Barney.
Yeah, I'm just trying to understand. It's not a question on that, This is all overhead transmission for me. And you shouldn't have said, this is Barney Mishra from XIMB. You should have said, Barney Mishra, my first PhD student. I feel proud in that.
Okay. That he is, yes.
So the question is, I'm trying to understand, partly based on the paper, partly based on the discussion. So as a dealer, I will watch what the others are doing in a game theoretic context and taking pure strategies. I sometimes may feel it incentive compatible to follow them. I may sometimes feel incentive compatible to just go in the opposite direction. So that's possible, right? Look, if I have a small holding, I may say I will do what others are doing. If I have a large holding, I will say I will not do what others are doing or go in the reverse direction. Is that possible? I'm just trying to understand, because Kumar said, sometimes they do that. Do they take the other's behavior and game theoretically decide when it makes sense to follow the hard game theory when it doesn't make sense?
I'll respond to that, Bani. So it's a very good question. You're thinking about it as a trader, and what we are talking about are if you like, the lifeblood of the market, which are the people in the market who keep the market going. They are the liquidity providers. They are the people who stand ready to buy and stand ready to sell, but they do so voluntarily in order to be able. They make money from the act of buying and selling. When you want to sell, they are there to buy. When you want to buy, they are there to sell. And therefore, they can't afford to keep an inventory for any period of time. And the question is, how do they manage that inventory? If they have information, reasons to believe that information exists, then they would not necessarily, follow somebody else. They would work on their own information. Most of the time, they just want to keep a position which is small, so that they earn money from the difference between the bid and the ask, and not take too much risk. So the inventory is managed with a mean reversion which is high towards zero, so they don't keep any inventories.
Okay, thank you. So they don't have as much discussion as I thought they would have. Okay, thank you.
They have a limited information. I think Pradeep is right. Yeah.
And limited discretion also in how to adjust the portfolio.
Yeah, they do what is optimal, but given their information set. Okay, Praj, you have a question?
Hi, Pradeep. Hi, Vikas. Nice to see you both. So I have a question that kind of follows up on Vikas's last response, looking at the cross-section of the traders. First, I'll say my question and then thought about how you can use the cross-section of traders to kind of answer that. So you show effect of sort of the inventory of the dealer network, so to speak, on liquidity and fragility. So my question is, how much of it is because of them responding to some exogenous factors and the liquidity and fragility also being driven by those exogenous factors, as opposed to a causal effect, so to speak, of their inventory positions? Okay? And so one way I thought this could be answered is looking at the top 50 VLPs versus the next 50 VLPs, because presumably they both are reacting in the same way to exogenous factors. But the next 50 VLPs, their inventory will not have as much effect on the liquidity and fragility in the market. So that's my question and thought.
So if I understood that correctly, you're trying to find a way of inferring causality here.
Causality. In some sense, to what extent dealers' positions are driving it. Yeah.
To kind of understand how much is it because they're responding to a situation and how much is it because they are actually causing it. Yes. Now, I mean, that's really tricky, of course. The top 50 and the bottom 50 is, of course, doable. The only issue would be you'd have to, first of all, establish that otherwise these top 50 and bottom 50 are very similar.
Mm-hmm.
And usually the way it works in these markets is while the top 100 are very different from everyone else, even within the top 100, you will find, the top 5 or the top 10 are going to be an entirely different animal to the 90. It's a fairly heterogeneous group. So that's going to be the only tricky bit. To the extent that we can match the top 50 with the bottom 50 in terms of trading attributes, I think that would be a very good strategy.
So yeah, my only thought was that to the extent top, not necessarily 50, but top 20, whatever, contribute to a large extent to the market making, their positions are more likely to have causal effect, for a lack of better word. I'm not looking for kind of strict identification, but that was the thought. But thank you for your response. Yeah.
Thank you.
Any more comments? Madhu, you had a question?
Yes, I had a comment actually, which Roman responded, but this is more out of my own curiosity in this space for Pradeep. So we know that, so there is an older paper by Baker and so on, who sort of talk about this cross momentum between stocks and bonds, and especially bond-like stocks. What I'm getting at is, it's not about this paper, but more generally, do we expect that such sort of portfolio inventory effects would also be sourced at this level, at an inventory level, where the information spillover could actually happen the way it's happening for stocks and peer stocks? It could actually happen for stocks and peer bonds.
I would think that that's certainly possible, but it's once again the bulk of the focus is really on inventory management, which is information free. So most of the market makers per se, the traditional literature and market making, assumes that the market makers don't have private information and so on. So, but in general, given that we are dealing with voluntary liquidity providers, a lot of the people who are, essentially traders who are effectively, as part of their trading activity, providing liquidity, keeping the market going, information can play a role, and that's one of the reasons why we added on an information element in the analysis that we looked at financial institutions whom we sort of saw earlier on that they have separately saw that they are more informed than the others. And their strategy showed some relevance of information as well as just pure inventory management. So yes, the information can include the spillover from bonds. And yes, if we have similar data on bonds, which of course in Indian context is probably not very liquid, that kind of analysis can be done. In relation to information, let me just also acknowledge the fact that in our one of our earlier discussions, the information angle was emphasized by Amber, a co-author of Kumar, and by Kumar himself. So we acknowledge their contribution to that context.
Thanks so much.
Okay. Any other comments or questions before I will go to concluding remarks?
I actually have a very sort of maybe basic question that Kumar may have already touched on when he said that there are many papers studying liquidity commonalities. So I guess my question is to both of you, Vikas, Kumar, and maybe Pradeep and Roman, whoever wants to answer. What is the theory underlying the result that liquidity in one security is influenced by liquidity providers' risk exposure to other securities?
Okay, so let me go at that in a sort of very basic way. The reason why liquidity spillovers exist, for example, in a limited order book market, is that the same traders who are providing liquidity, keep in mind that liquidity provision is voluntary. Keep in mind that liquidity provision is done essentially by traders who are going home flat and who are earning money from the bid-offer spread and carrying the risk of carrying that inventory in order to be able to make a profit. And they would typically not just make an market or offer liquidity just in one stock. They would offer liquidity in a large number of stocks. And if you are carrying the risk of inventory, you are therefore carrying portfolio risk, the risk of the inventory of the entire portfolio, not just one stock. And therefore, if there is a major action, so if I hold, as in take Kumar's example, if I am one long in JP Morgan, then I'd be very hesitant to buy a 1 million block of Bank of America. I would be much more aggressive in offering pricing to sell Bank of America stock, because that way my overall risk to the banking sector is low. So I'm offsetting my risk.
Specifically, just to interrupt you quickly, so it's specifically then it's influenced by their exposure to a particular type of stocks, not any stocks.
The critical issue is correlation. I used Kumar used the Bank of America and JP Morgan example because clearly they are the same sectors, they would be correlated. So effectively, any kind of correlated, it's like saying you would like to be diversified and therefore reduce your exposure, but it's not just diversified. It is you're using systematic risk to be zero as well.
I missed. Yeah, okay. So that explains. Yeah.
Okay.
Thank you.
Okay, any other comments or questions? I think it's late in India. I'm told it's even midnight in India. I don't know whether that's true, but we have to wind down. Let me just invite you all, of course, for the program tomorrow, which is also exciting, which is a really exciting program. We have a keynote speaker who is Nouriel Roubini, my colleague, and of course he's famous for making predictions, and he has agreed to make some predictions tomorrow. So that'll be an exciting keynote speech. And of course we have two great papers. Rama is going to present a paper on IPOs, very interesting paper, and Jay Ritter, sort of the world expert on IPOs, is going to discuss the paper. And then we have a very interesting paper from two doctoral students, actually, Shohini, and they have a paper, Nishant Watts and Shohini Kundu from University of Chicago. They actually ask how can you tie the geographical variation in corporate investments on the colonial history of India? As you can imagine, that's going to be an exciting paper. And we have Francesco D'Acunto, who himself has written papers like these as the discussant. So we have an exciting program tomorrow. I hope to see you all there. Tirthankar, if you want to say something, that'll be fantastic.
No, of course. I mean, we've had a great day today and fabulous discussion, panel discussion, which really delivered everything that it promised.
I agree.
Panel members do not shy away from pointing out some hard truths. And thanks a lot, and hope to see all of you guys tomorrow as well.
Thank you all. Thank you. It's fantastic. Thank you very much.